Well. Cool. We are live now. We are up break even, hovering about a point to break even on our current position here. Did go long. We'll see if this Apple push carries us, if we see a change in Microsoft and Amazon as well. IWM weakness out of the three, it's the one that's struggling the most. It's the one leading to the downside. So it could be our just leading indicator to the downside. Let's see if we reject here. Could very well just bear flag until the next step down here. Next step down on SPY, we're looking at 626, 4Qs, looking all the way down to 557. Those should be fairly familiar to us. On IWM, it'd be 222. Upside though, if we do get that move, it's just VWAP. That's what I'm looking for is a test of VWAP on all of these. SPY sitting right around 628.25. Q sitting right around 561.73. IWM at around 224.20.
The early bird catches the gaze. This is Morning Brief Market Sunrise. Live from London, we deliver an early read on global markets. From overnight action in Asia to real-time sentiment across Europe's major trading desks and a live look at US futures. We cover the stories to help you, the individual investor, get the edge with actionable financial information and unbeatable context. So grab that coffee, tap in, and let's own the morning.
This hour on Market Catalyst. First up, Investor Playbook. We discuss a week of earnings and economic data and what it means for your portfolio. Plus, consumers are facing the highest average effective tariff rate in more than a century. We'll discuss the effect on the economy. Plus, copper prices are trading at records ahead of that 50% tariff that President Trump announced. We'll talk about the effort to build U.S. copper mines. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets and where we stand here. All three major averages have turned down, not by much, but seeing deterioration here. Remember, the S&P and the Nasdaq yesterday closed at record highs. The S&P earlier touched a record high before falling back a bit. The Dow leading the decline stayed down almost 200 points, about a fourth of 1%. And we've been watching the bond market as well, but there we have not been seeing a heck of a lot of movement, not just today, even this week. I feel like I have said the number 4.43% this week a lot because we have been staying in a relatively tight range there. But let's get to the broader stock market here. Stocks are indeed pulling back after the S&P 500 and Nasdaq hit fresh record highs. Still, Wall Street is on track for a winning week as investors digest strong earnings and a big week of economic data. Joining me now, Yahoo Finance's Josh Schaefer and Mark Malik, Siebert Financial CIO. So, Josh, you've been obviously watching the markets all week. What have been sort of the signposts, if you will, as we've gone through the week?
Sure, Julie. I mean, we actually had quite a bit of news this week, right? It is the middle of summer, but it's that period of summer where we really do start to get a lot of news flow, right? So we had multiple inflation readings. If you split them between the consumer price reading, the producer price reading, you had some signs of sticky inflation, some signs of maybe a little bit better inflation, right? But we sort of came out of that with market expecting 50% chance of a September cut. That was kind of the Fed side of things. Then you also have the Fed debate heating up about who will replace Federal Reserve Chair Jerome Powell and whether or not he would be fired. We passed through that. And again, as you said, now we're kind of almost just, it feels like we're almost flat on the week at this point. And I didn't even mention earnings, which we heard from a lot of companies. But I think broadly, just speaking about the index and S&P 500 earnings, I think you could make the case that the index is probably on pace coming out of week one here. You got a lot of beats, a lot of relatively positive readings, I think, from that.
Yeah, so Mark, on balance, you feeling bullish, bearish coming out of this week, right? I mean, it's hard to sift through all of these things that we're talking about.
Yeah, I'm always, I have been a bull coming.
Watch what tech does here as IWM small caps try to hold or bounce.
And I think all the flags are sort of pointing in the right direction for momentum to continue carrying us forward. I mean, like you suggested earlier, we had CPI, we had PPI. Now CPI, a little bit of a mixed picture, but still, if you dig deeply into the number, it's nothing terrible yet. It's not the horrible tariff-based inflation that we were all waiting for. We're still waiting for. We haven't seen it yet. Of course, you've seen some tick-ups in a couple of the areas, but overall, it was not a horrible inflation number. The PPI came in really soft, which is also a positive sign. And of course, we have had earnings, which also they've been pretty positive. I mean, the bars are a little bit low, but they're rising. And so, misses there could be horrific. And there have not been any major whiffs this week. We've seen a couple of people pull back on guidance, which, those stocks were punished as we expected. But for the most part, I think it makes sense that the market is somewhat trading higher, even with
Microsoft showing weakness here, Amazon wanting to pull back as well. So eye on those.
Okay, I mean, it's a
Q's Dragon, potential new low of day.
Pulling their guidance and just saying
About 10 or so cents away from that.
If you're on uncertain watch this quarter, right? We were doing this sort of word search for how many times these companies were saying tariffs or uncertainty. I would imagine the numbers going down a little bit.
Yeah, I agree. I mean, it's seeming a little bit more positive when we're looking at the earnings. I think what I like certainly about this week is I like when the big banks come out because they talk about how the consumer's doing, right? And these are like, the JP Morgan Chases, the Citis. Between the two of them, I think they corner the market in consumer credit cards. And you're hearing from them that consumers are still strong. Now, of course, there's stratification between lower end.
You got 10 minutes left on these 15-minute candles we're watching right now.
The consumer's not falling out of bed yet.
RSI on the lower end.
Strong. They're still doing what they're supposed to be doing, which is consume.
Yeah.
I think we're hearing positive signs.
And sort of the other thing with that too, Mark, really just kind of brought this up, but last quarter we talked a lot about we don't know yet, essentially, right?
Yeah.
Uncertainty. But this was a quarter that we did have tariffs. I feel like I don't know, at least I haven't talked that much about that this week, right? This was April to June. We had tariffs in place, so you're getting real outlooks from companies now too. So it's not the shoulder shrug you could do last quarter of, oh, well, they don't really know yet, so I don't really know yet. Maybe there's fake confidence here. If corporates are showing confidence at this point, they understand at least somewhat where
but
policy is.
I will say the caveat is we haven't heard from many companies yet that are going to. I mean, yes, we've heard from like Pepsi, which could potentially, companies like that might see an impact. We haven't heard from the bulk of the industrials, for example, or companies that make things. Retail is later in the season, so that could be a different tenor. So we haven't quite gotten I guess the full picture. From those companies. I mean, sectorally, or are you looking more on a stock-specific basis when we're talking earnings, Mark?
Still down about 2 points here on my position, so waiting to see whether or not we get that break to the upside or we cut.
Potential opportunity there, even though there are challenges for those sectors as well, given the tariffs, but they have so much potential growth opportunity. It allows them to go beyond worrying about buying widgets and marking them up and reselling them. And a lot of them have what I refer to as pricing power. So they would be able to pass them on to the consumer if they needed to. Bad for us as consumers, but good for them as stocks that we own. But of course, we're going to have, as you said, in the next couple of weeks, we're going to start to have those, what I refer to as smokestack industries, the industrials. We're going to hear a little bit more. That's why I think we said earlier we were talking about
down a point, hovering at around break even. Let's see if we get the upside push.
So I said all the flags are heading in the right direction for now. Right?
Maybe that's
Target here, I mean, for a quick snipe, for a quick in and out, I would look for like a 3-point move, but I'm aiming for 63.39 if we get the upside break. Longer upside target would be at around 63.44, 63.45 if we get the break.
The week and looking forward, he's the chief strategist over at Piper Sandler. He answered kind of a question that I like to ask myself when we get back toward record highs, which is instead of constantly asking what are the risks, I feel like we spend all day talking about the risks right now and they feel rather obvious, right? The economy could turn, tariffs could impact this whole story, et cetera, et cetera. Why are we rallying? Why are we at record highs, right? And why could that keep moving the market higher, I think is also an important question to be asking yourself right now. And Kantrowitz points out, earnings revisions breadth, meaning the wide swath of companies that have seen revisions come up since the April bottom has continued to improve. That's something that Morgan Stanley's Mike Wilson has also been pointing out. Kantrowitz also pointing out that yes, valuations are high. We just talked about tech. Think about this market. When we talk about the average PE for the S&P 500 over the last decade or the last 20 years, well, the S&P 500 is a lot more tech than it used to be. And so it makes a little bit of sense that the valuation would continue to be high, right? And so just thinking about what's been driving it, and I guess sort of to round out that thought going back to Mark's point, you could perhaps make the argument that tech earnings over the next 2 or 3 weeks will just give us a lot more sense when we think about this bull market, what's driving this bull market.
Watch tech here. Let's see if tech can get that bounce. We need Microsoft to push here as well.
And if they can do that, that feels like the next.
Well, the question is though, do you get
1 minute left on these 5-minute candles. Position right under break even. Let's see what the last 5 minutes on these 15-minute candles we're watching do for us.
It's always an interesting one, right? Because we always get them first, and they're not really kind of a technology company, but they do typically set the mood, right? Because that's one of the first sort of big growth stories that we listen to. But I think that their story is a different one, right?
Right.
And so when somebody says,
Well, but do you think there is a risk that the other tech stocks will fall even if the numbers are
absolutely,
good?
absolutely, right? There is so much high expectation. The whisper feelings out there on these companies, right?
We are now into the last 5 minutes of these 15-minute candles we're currently watching.
A challenge. However, we'd like to see something strong. There's certainly the possibility that these things pull back,
Right.
even though they might beat wildly. But in that case, I will tell you, those are buying opportunities.
Well,
right?
I mean, look at NVIDIA as an example, right?
Yeah.
That's certainly been the case there when it has that pullbacks on earnings.
There's no question. I mean, look at the opportunities that still exist. Those opportunities, no one has been able to challenge.
We are now break even. Let's see if we get a slight push to the upside.
And so, yes, companies have ups and
Let's see if we were able to collect any coins.
across the tape, but it doesn't change the thesis. And
Just being
they still have
patient
great
with it.
margins,
Up
They still have great opportunity.
half a
Demand is
point.
still high. They have price power. They have all
Rejecting
these
at that
moats
half a
there.
point. It's the
So
same area
despite
where
all
it
the
previously
challenges,
rejected up
these
here
companies, you can't argue with the
at our
growth.
initial
It's
entry.
down because people are just exhausted, and it's possible people do get exhausted with buying. That, to me, is it's down for the wrong reason. And so until you tell me something where, no, the market's not really there, then I'm going to continue to, respect these higher valuations. And companies can stay at high valuations for long periods of time.
Yeah,
So.
we have learned that for sure.
As we've learned, yeah.
Josh, thank you. Mark's going to stick around. We're going to dig into the tariff story a little bit further because
Candles getting smacked right back down.
that have not been seen in over a century, and that's before that August 1st deadline. We're going to break down the economic implications next.
And it's IWM, the one that's pulling us back. See how tech tried to bounce here, right? And then IWM just got smacked right back down to the low. I mean, it's like 20 cents away from making a new low again. So it's that small cap weakness that's dragging us down, at least SPY, ES. So ultimately, we're looking for a reversal on both, right? We need to see tech and IWM, so Qs and IWM, both push up together, and that's when we get our upside breakout. Amazon pushing here up to VWAP. Want to see Microsoft push as well. We are into the last minute of these 15-minute candles we're currently watching. Let's see where it takes us. All right, new 15-minute candles here. And I did notice that, or got the notification that our funds have now settled for the options account. So we'll see if we maybe second half of day into closing are able to pick up or just scout any potential positions for the upcoming week. Definitely something I'll have an eye on. Remember, this is meant to be a smaller account. It is a total of like $500. So we will be looking to go into positions between like 1-2 contracts, all contracts under $100.
Ernie Tedeschi's back with us, Yale Director of Economics at the Budget Lab, and still with us is Mark Malik, a Siebert Financial CIO. Ernie, it's great to see you. I'd love to check in with you as you do these calculations here on these effective tariffs. So to be clear here, this tariff rate that we're talking about is not including what could happen on August 1st, correct?
No, so the 20.6%, which is the highest since 1910 for the United States, that is like an August 1st effective rate. So that includes all of the letters that went out two weeks ago. That includes the 50% copper tariff. But it doesn't assume that other rates that we haven't gotten letters yet for revert. It assumes that everybody stays where they are now, and then the letters take effect. So that's a substantial rate. We project in our economic modeling that would shave roughly 90 basis points off of growth in 2025 as a result of that, which is a major headwind. I like to emphasize to people, though, like that is not a recession necessarily. If you were at 2%,
we got price trying to push up here. We're now again right below break even, a quarter of a point away from that break even mark. So we'll see if we push. Probably looking to take profit here if we do break with a little bit of strength.
More money and putting it in its coffers. As we know, that doesn't mean that companies and people aren't paying the tariffs themselves, and then it's going in the government's.
There we go. It's trying to break up a quarter of a point.
The benefit, if you see it as one,
hovering at break even.
Going into the U.S.
Sure. So we
just need that momentum. That 63.36 mark has been pretty strong, so we want that's ultimately what we want to break and hold above right now.
If someone wasn't paying it. We also know from import prices,
or at some point today.
Ex tariffs, import prices haven't fallen, so foreign companies are not absorbing very much, if any, of the tariffs. This is all being paid by Americans. We've raised about $110 billion total.
Got 2 minutes left on this first 5-minute candle. Let's see where it holds up.
Before these new ones went into effect in 2025. So we've probably
we're at break even again.
$50 billion in revenues.
Slightly in the green.
And look, that definitely lowers the deficit. That's a good thing.
So we go half a point, hovering between half a point to a quarter of a point. Not the biggest gain, but happy to take whatever we get.
Incomes, because tariffs affect productivity. That means lower worker pay, lower company.
Remember, ultimately, our average for the day, what we're looking for is just 3 points. 3 points is what we're aiming for throughout the entirety of the day. Back in the red, about a point, half a point. It's struggling there at the 63.36 mark. Into the last minute of the first 5-minute candle.
We keep talking about for now. I'm concerned that many analysts have not yet factored in the actual impairments of these potential inflations.
And with IWM small cap weakness, it just keeps getting smacked down. We need IWM to break.
Then I'm going to see what's the cost, what part of that cost can be pushed onto the consumer. But we know that it's
30 seconds left on that first 5-minute candle.
Corporations are going to be it's going to be a cost of earnings, or it's going to come right to the consumer. We haven't really factored that in yet. Generally speaking, the market's trying to digest all this, and so far it's done a good job. But I think there's another shoe to drop soon.
Well, speaking of a shoe to drop, Ernie, I want to talk to you about where we could see the biggest tariff bites.
There we go, new 5-minute candle. 10 minutes left on these 15-minute candles we're watching.
What sector should we be watching that could see the potential biggest hits?
Sure. It's not going to come as any surprise that goods that are more likely to be imported, and in particular imported from the countries that have the higher tariff rates, are the ones that are going to be disproportionately hit. So in the short run, and by short run here I mean next year or two, the areas that are going to see the biggest hit are going to be what we call leather products, so shoes and handbags. They're going to see a 42% price increase as a result of these tariffs.
Let's see if momentum can sustain here.
Price increase. Now, over time, there will be
still down a little bit over a point,
there might even be
point and a half,
to the United States.
back to a point.
There will probably be more shifts in production across
Let's see.
Different countries, away from China toward lower tariff countries. Even then,
It's IWM. We need IWM. Come on, small caps.
Shoe prices will be persistently 19% higher. Apparel prices 18% higher. That's going to particularly impact low-income consumers. Low-income consumers spend a greater share of their budget on imports in general because imports tend to be lower priced, and so they are almost tailor-made to be hit disproportionately by tariffs as a tax.
And Mark, do you then want to just stay away from those kinds of sectors entirely? Do you avoid apparel? Do you avoid footwear, for example, in this kind of environment?
Yeah, I think we have been very conscious of the potential for this to happen. I mean, we actually started looking very closely, ended up last year after the president won the election. There was going to be a challenge in the supply chain, and we went after the usual suspects, and we sharpened our pencils, and we took some risk off in those sectors. I don't think it's appropriate to completely go away from those sectors. However, we definitely are.
Okay, bigger candle here. IWM just, it's going to spill, right? That's what it feels like.
Something else I want to ask you about is the big tax and spending bill, right? Because
see if it holds.
some folks come on here and talk about that as a stimulative force in the economy.
Come on, tech.
Analysis, does that
Tech trying to hold us up.
Right. Right. In our analysis, did Congress to fully extend the 2017 tax law, which I think most analysts did. What they ended up passing went above and beyond that, especially in the short run. Most of the pay-fors in that bill that lowered the cost later in the 10-year window. So you do get some gross impulse.
Let's see, 2 minutes left on this 5-minute candle. Total of 7 on the 15-minute candles we're watching.
Which we think is the appropriate way to think about it, because this administration made, I think, a fair argument that the tax bill costs a certain amount, but then they were raising extra money from tariffs as well. So they were thinking about the two policies in tandem.
And Mark, what about you? How do you think about the two policies in tandem?
Yeah, no, I think it's certainly, we believe that certainly the tax act that just passed is going to be stimulative to the economy. Whether it offsets the tariffs at this point, it's unfortunately too early to tell. But when you're looking at a number that's 20%, that could be the effective tariff rate. I think that the calculus there is going to be tough to true up.
Yeah, Ernie, Mark, thanks a lot. Have a great weekend. Appreciate it.
1 minute left on the current 5-minute candle. Total of 6 on the 15-minute candles we're watching currently. See, position again within 1 to 2 points away from break even again. We're trying to hold there, so that looks a little promising, but we want the break above 63.36 on ES. Four minutes left on these 15-minute candles we're currently watching. And I'm watching Apple closely. See if it holds tech up here. Amazon at VWAP. Apple right above it trying to hold. Pushing tech. Let's see if we get the push here. Down a point. Three minutes left on these 15-minute candles we're watching.
Welcome back to Yahoo Finance. I'm Ali Canal live at the NASDAQ, and we're taking a look at the market action about 90 minutes into the trading day. We're seeing the Dow off around 150.
We are break even now on our position again, hovering right around it. Let's see if we get the upside push. The highest I've gone is about like half a point. It just keeps rejecting around that 63, the 63.35 area, 63.36. So we need to break that.
Especially amid all the volatility and those high interest rates, which for the current moment might be higher for longer here, with the market now pricing in just a 50-50 chance that the Fed cuts interest rates in September. But speaking of rates, let's take a look at the bond market. This has been a big focus really all year long, but especially this week. If we take a look at a 5-day period, you'll see earlier in the week the 10-year Treasury yield spiked a bit. We are now back at those levels closer to 4.4%. Now this happened after reports started to emerge that President Trump was seriously considering firing Fed Chair Jerome Powell. That spooked the bond market. Ultimately, Trump walked back those comments, and now we have those levels that are settling.
We got a minute 30 left on these current 15-minute candles that we're watching. We're just hovering at break even, going green a little bit, just a quarter of a point. Let's see if we can get a point here at least. If not, I'll take what I can get. I keep saying that, but I don't close, right? I should just take that quarter of a point, honestly. Let's see what this last minute gives us here on these 15-minute candles that we're watching.
Netflix, for example, recently raised their full-year guidance, and they did cite the help of the dollar and the fact that that is depreciating when it comes to some of those international sales. So something that we're going to continue to track this earnings season, and we will keep tabs on the market moves here on Yahoo Finance later on in the session.
Now let's get to some of today's trending tickers. We're watching Humana, Chipotle, and Roku. And our senior markets reporter, Ali Canal, is still with us live from the NASDAQ. First up, let's get to Humana. It's falling after...
See, 20 seconds left on these candles.
The health insurer sued to try to undo cuts to its Medicare bonus payments, hoping to restore billions of dollars in revenue. The government had lowered Humana's quality rating, which means the company gets...
right under break even. Half a point. New 15-minute candles here. Let's see if we get a push up half a point. See, up 3/4 of a point. It's struggling, man. It's IWM. Come on, give us that push.
A little bit higher.
Can we get a point? Can we get a point here? Nope. Right back down to break even. It's IWM. Take a look at this, right? As tech tries to push, IWM struggling. I do not like that at all.
Eligible plans, and that's a big deal because these star ratings, they help determine how much money insurers receive in bonuses. And for Humana, that's core to their business. In 2024 alone,
let's see, half a point there again. There we go. We got our point. Almost 2 points. We're up 1.5 points. Let's see if we can get it. Oh man, too slow. Why didn't I close on that spike? Up $75 here, 87. Let's see if we get the 100, that 2 point mark. Okay, we're at 2 points. I see us push potentially into 63.39. So looking for those 2 additional points. Let's see what we get. There we go. Almost up 2.5 points. Let's see if we get that push. Come on, can't get greedy here. We're up 2.5 points here. Flirting with 2 3/4. Let's see if we get the 3-point mark here and hit our goal. Let's see. I see the push. I see the push. I really think we get it, but a great point to exit here as we see IWM again slow down a bit. But let's see if tech pushes us up here slightly ever more. I'm seeing that struggle, man. I might just take here. Great point to take. Let's see. Let's see. Yeah. It wants to give us 150, but it's just struggling there. It's struggling a bit, being a little slow. We need IWM to give us that little nudge. Back down to 2 points. Let's see. Let's see. Do we get it? Might just take my 2.5 points here. Never a bad trade. There we go. It wants to push. Come on, baby. Give us those 3 points. Amazing. We're a little bit higher, and this is what I'm seeing, right? Awesome. 162 mark, 175 here. Let's see if we give us, honestly, sell into strength. We're out.
Order filled.
187 total. Amazing. Sweet. There we go. In and out. You saw that trade play out. Entry here initially on this candle. Our break even was right around here, around 634.75, and we essentially just caught this whole push, right? You always sell into strength. You don't want to wait for it to reject like it might here. So amazing trade there. Very happy with what we did. Anybody join me on that slight pop and take a look, right? The reason that I sold into strength there is if you take a look here, both on SPY and Qs, so tech, we came right up to VWAP and it's struggling there, right? So I don't doubt that we break up and continue that journey to the upside at all. But what I'm struggling with is IWM here. And that's what's going to happen. I guarantee you that's probably how it's going to play out, is when IWM consolidates enough, builds enough momentum, and it pushes up to VWAP, these are both going to break VWAP, right? But in doing that, we also want to see Apple continue to push and make a new high of day. We want to see Microsoft push up to VWAP. Amazon's holding so far. I mean, we can even take a look at Nvidia and some of the others, right? Nvidia's been struggling, so we wanted to see curl back to the upside there. Meta V-shaped recovery potential. So tech overall, it's looking pretty solid, right? It is small caps, look, the one that's still dragging us down. So just keep an eye on it. If this moves together, if tech, small caps can both push to VWAP and above, we're going to get that potential breakout move in. Yes, but all I was looking for was that bounce play, right? And let me go ahead and post this in the group for all of us, just so we can see that trade that we were able to execute on. Recap for the whole week coming this week, and look, we're right back up, right? Wanting to push back up, it is because IWM's now holding. And what did I say? If IWM holds, consolidates, tries to push, what's tech going to do? It's going to come in a VWAP. It's going to then start pulling SPY up alongside it, as long as IWM moves with it too. And this is largely in part to these three. Apple pushing for potential new high of day, Microsoft wanting to V-shape recovery, and then Amazon holding or trying to stay above VWAP. So we'll see. We'll see where it takes us. Let's go ahead.
in Arizona is certainly critical. Copper is one of the most important.
Just posted that breakdown in the group. Let's screenshot our total P&L. So we are now up 182.50 for the day. It's more than enough, right? We've been hovering above that daily target of 3 points or $150 pretty much every trading day. So doing really well, really well. About another week or so until we pass the remaining trials or evals on Take Profit Trader. After that, after these last few are wrapped up, we're going to be at a total of 5 funded accounts on Take Profit Trader. Once we reach that, I'll probably, the goal is to ideally, God willing, have these completed by the end of this month. And that would then give us all of August to trade the funded accounts, boost our revenue back up, and then the goal will be to split that revenue half into adding to the long term. As you all know, currently what we're holding is RXRX and VSCO. So looking to either add to those positions or maybe pick up some other ones. Intel's been one that I'm looking for the long run, right? Something that I can potentially hold until the next 10 decade plus. So we'll go ahead and see what that potential gives us depending on the payout. And then in addition to that, maybe looking to expand our funded accounts into other prop firms. But in all honesty, I'm fairly comfortable with what we have. We already have a good amount of accounts on Apex. We have Take Profit Trader. The biggest difference, though, is I feel like when I'm trading the Apex accounts, it feels so draining. And it feels super draining because of the what's it, not restrictions, but the rules, right? The limits to an extent that are imposed on us as far as how you go about trading your account, the trails, the active trailing, right, for positions that are it's not like an end of day type of thing. So it makes it more difficult. So you really have to be on top of it, which I mean, you really should be in no matter what form you're trading, whether it's options, futures, your own money, or whether you're funded. So it just takes a lot more. And in comparison to the flexibility of Take Profit Trader, it feels different, and I've felt a lot more comfortable with TPT so far. And not that I'm like trying to advertise for this. I will never advertise any sort of prop firm, because at the end of the day, that they're there to collect funds based off of us losing, right, and failing trials or evals. So that's another thing to keep in mind. But the big thing, blessing that I've gotten from TPT, is those daily withdrawals, right? Once you're funded, once you reach that $2,000 trailing threshold, especially with a total of 5 accounts, it's going to be a lot more flexible in how we operate and how we're able to collect funds to keep pouring back into the long term, because that's the whole idea behind this, is to build out the long term. If you're not building out a long term, if you don't have a long term, you probably should not be trading options, and you probably should not be trading or paying for funded accounts, because that money could be going through to your long-term portfolio. But that's just my rant there. Let's go ahead and tune back into Yahoo Finance and see where we can hunt our next setup.
Globally, and those projects, because of their large capital requirements, typically do require.
Let me know if you all have any questions. Feel free to ask in the chat.
Taylor, really good to catch up with you. Really interesting topic, especially right now. Thank you for your time.
Thanks for having us. Appreciate it.
Well, we're watching the markets action coming up. Stay tuned. You're watching Markets Catalysts.
Just keep a close eye here. It looks like buyers could be trying to trigger that reversal on the 15-30 minute chart. So definitely something to keep an eye on. We need a push above 637.50. Could have been a great entry in the slight reversal. All it did was come back to our entry point, to our break even, and it's now pushing back up. It literally we could have entered again and pretty much doubled our gains based off of where it's pushing up to now. But it is what it is. We're patient with the market, right? We get what we get. We've already taken our spoils for the day, so I'm really not pressed or too concerned about getting into another trade for today, especially with all of current market conditions. But we're chilling. We're chilling. We'll see if another opportunity comes up. It will, right? Opportunities come up all throughout the day, so definitely don't feel pressed or rushed to go into anything.
news about President Trump, it lit up global markets yesterday as headlines about firing Federal Reserve Chair Jerome Powell sent stocks plummeting as yields popped. On today's Stocks in Translation, we're going to look at prediction markets or binary market futures. And here's the definition. These are financial contracts regulated by the Commodity Futures Trading Commission that let you bet on whether a specific event will happen, paying $1 if it does and nothing if it doesn't. It's either or, hence the term binary. And here is a chart of Thursday's price action in the S&P 500 and what was happening in the prediction market. And in green here, we have the S&P 500. Just as the odds, as all those headlines about President Trump possibly firing not President Powell, he's the chair of the Federal Reserve, we saw those odds go up and we saw the stock market go down. It was pretty well timed here. And what's interesting is that stocks were managed to recover all those losses and actually close close to the highs of the day.
Tech wanting to break VWAP here.
This is the same prediction market versus the 30-year yield. And you can see here they were actually going in the same direction. And unlike stocks, the 30-year did not come back all the way down. In fact, it stayed above that critical 5% level into the close as it did the very next day.
So tempting to go back in, but we got to chill.
Take a look at a longer-term chart with prediction odds and the S&P 500. This goes all the way back to January 30th, and I'm going to show you.
Get some push-ups in, right? Let's get active. Can't just be sitting here the whole day. Man, just watch tech. Keep a close eye on this. If you're looking for an entry, this could be a pretty good one. With tech trying to push above VWAP, and take a look at IWM, right? This is what we talked about from the start. We want to see them push together. If they do, watch ES, watch SPY. It's going to break VWAP as well.
Never even got above 50%. So since we've seen a lot of these binary betting futures kind of rise in popularity over the years, I just wanted to show you a table that compares and contrasts them with auction markets. And so that's what we would traditionally call the stock market or the bond market or even commodity markets. So the first is a payout. In binary betting futures, we have all or nothing. That's $1 or zero. And of course, in the stock market, it depends on the per share price. And that can go up, it can go down, and it fluctuates on a minute-by-minute basis. And then another factor is price. We have, for binary betting, we have the implied price change versus the current market value as determined by market participants in these auction markets, the stock market, for instance. And then as far as risk is concerned, we have a fixed max loss in the binary betting.
You got tech breaking above VWAP. Watch small caps. We need it to push as well. And SPY, ES, it'll break VWAP too.
It's going to fluctuate on a minute-to-minute basis. And then finally, the typical focus here for prediction markets.
Ultimately here, you're looking for a push above 63.40 into 63.45. If we do hold this with momentum, look for that high of day, or at least open. Market open is the first one, right around 63.50. So about a 12-point move available.
Accurate information that's more so than
that's if momentum holds.
Decisions becoming the norm, these markets are only likely to grow in size. So tune into Stocks in Translation for more jargon-busting deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Wild. Did you all see what came out 40 minutes ago? I didn't even see this. Dow Jones Newswires, what they released. Robinhood could soon join the S&P 500. That's insane. You got tech pushing. ES SPY now at VWAP. Wow. Nice push. Nice push. We're now above our exit. So like I said, it was so tempting. We could have gone back in. Easy. It would have been money, but it is what it is. Don't want to chase now. And it's at our target. Remember the initial profit take we had was at 63.39.50. It's hit. Might retrace a bit here, might consolidate here. Yes, trying to push here, and it's because of IWM. It's exactly what we were talking about. It's the reason why we took that trade, and it's just pushing. Everything's at VWAP now. Tech is above, trying to hold. So we'll see where it lands. We are currently about 8 minutes away from closing the 15-minute candles that we're eyeing here.
Second quarter earnings results. Year to date, shares of the EV maker are underperforming the broader market.
2.5 minutes from this 5-minute candle. You all see where we're at? We're at break even for the day. So these are trying to go green. SPY is green above 7 cents. Q's is hovering at break even. Right now it's red 3 cents. IWM's the one that's down still 37 cents, about a tenth of a percent.
A 9% drop compared to a year ago on adjusted EPS of 43 cents. We've seen deliveries were weak in Q2. How much of that was because of the Model Y changeover? Is that top seller still available? Is it already available in most of the major markets? We'll see. You need to hear more on that. So number 2 is the robotaxi rollout, right? So this is good news, for them. Austin happening on schedule and now expanding. What's next for expansion plans in new regions? Musk said California was coming, but there were reports that no permits have been applied for yet, right? So, and what about the use of safety drivers? Are they going to have the person sitting in the passenger seat the whole time? Waymo is the undisputed king here with robotaxi, and we just saw that Uber's getting into space as well with Lucid, so competition rising here. Finally, where's that cheaper EV, right? We a year ago, Tesla said it was going to come out in the first half of 2025. We haven't seen anything yet. Can we still count on it happening at all this year? Barclays' Dan Levy talked about how Tesla will probably push the launch or sort of reveal of that cheap EV in the fall after the EV tax credit goes away, right? As a way to sort of maybe jump demand. We'll see, but even if it will, it's going to definitely come up on earnings today. Or sorry, when they report earnings.
Yes, July 23rd is when we are looking for those numbers. And Pras, the backdrop for this, of course, is that the stock is still underwater pretty deeply for the year. I think it's down, certainly more than 15% on the year. And so there's not a lot of optimism. I mean, there's always optimism from the Tesla faithful. You and I know them well. But it doesn't seem like from the market writ large that there's a lot of optimism here.
Yeah, stock's down 20%. It was down 40% at the end of Q1, Julie. So there is a little bit of pairing of those losses. But yeah, you're looking at what are the upside catalysts for a stock that maybe sort of petered out a little bit. I mean, the bulls are all fully in, but Wall Street wanted to see what's going to justify that valuation. We talk about robotaxi rollout. Maybe we'll get more crucial information on there. But Musk was teasing. I regret to say he was teasing, or forgot to say he was teasing a very dramatic reveal of a vehicle coming out later in the end of the year to show. He wants to show people this demo of something. We don't know what that is. Maybe it's that long-awaited new roadster. But is it really going to move the needle? Like, I think they need to really wow people out of the gate. Something like a Cybercab or something like of that nature that will actually come out soon. That will sort of move the needle beyond all the negative press that Tesla has with Musk and all the new competitors that are on the space that are actually competitively priced. So yeah, they need something that's going to really keep the stock afloat. Otherwise, it's going to be more and more about the weakening auto business.
Right, the thing that they actually do now instead of the things that they're doing tomorrow. Pras, thanks so much. Looking forward to that report. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We've got more Yahoo Finance coming up.
Are you ready to master the markets and, dare I say, become a better investor in the process? Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights.
IWM just squeezing between the 5 moving average and VWAP. So is SPY. As long as Q's tech holds up here, could build us that momentum and break to the upside.
And wherever you get your podcasts.
Looks like we're pushing up. 1 more minute left on these 15-minute candles we're watching. "30 seconds. IWM is the one that's retracing a bit, but tech holding it up so far. We go, new 15-minute candles. Would like to see a slight dip back and bounce, but we'll see. Could just launch from here, right? Who knows? Just watch on IWM. There we go. Slight retracement.
It's time for Yahoo Finance's Market Minute. Stocks are fluctuating. The Dow has been negative while the S&P and Nasdaq are just above the flat line, holding near Thursday's record high close. Crypto stocks, Robinhood and Coinbase are jumping as Congress wraps up Crypto Week with a few wins. The House passing the Genius Act with bipartisan support. Meanwhile, the Clarity Act, which lays out the framework for categorizing digital assets, advanced to the Senate. Chinese tech stocks gaining after a banner week. The Hang Seng Index closing at its highest level in 3 years. That's after China's commerce minister told reporters that recent talks showed there was no need for a tariff war. And CRISPR Therapeutics shares surging to a 52-week high after the company's director disclosed a $51.5 million stock purchase in an SEC filing. That stock is up over 60% so far this year. And that's your Yahoo Finance Market Minute. Scan the QR code below to track the best and worst performing stocks.
Got that retracement. I would like for it to retest the break, but it might just be holding VWAP here as far as SPY and tech. Again, we need small caps IWM to break VWAP.
As we do take a look at stocks, let's just skip the stocks. Let's do that here. So as we watch stocks potentially pushing to new highs here today, we've got the S&P 500 up about 0.25% here. The Nasdaq is up 0.25% as well. Any gains for them today would be new record closes on the session. It looks like that they have also hit intraday highs here. As well, we've got the Dow heading in the opposite direction, down about 47 points right now. That is about 0.1%. So interesting to see this action here. We've got earnings underlying it. We, of course, have also got what's going on with the debate over Fed independence. So all of this contributing to the action that we are watching in today's session. And then, of course, we're watching the situation with what's going on with crypto as well as we have that action in Washington. Take a look at yields here today. That 4.3% on the 10-year, we've really been hovering right around that level all week, even with the drama over the Federal Reserve. And let's get to that drama right now. Fed Governor Christopher Waller made his strongest call yet for a rate cut in July. Waller, who's reportedly on Trump's short list to replace Powell as Fed chair, opened a speech Thursday bluntly stating, quote, "I believe we should cut the policy rate at our meeting in 2 weeks." With me now to discuss his commentary, Brian Jacobson, Annex Wealth Management Chief Economist and Strategist. Brian, it's great to see you. And I would love your take on Chris Waller's argument, which this was not a tweet argument, right? This was not a press conference soundbite. This was sort of a long, laid out argument for why he thinks the labor market in particular is weaker than it appears and warrants a cut. What do you think? Does he make a convincing argument?
Well, I think you're absolutely right. There is a lot of stake and not necessarily just sizzle to what he said. And if you think about the trajectory of Waller's views on monetary policy, I think he does really bear listening to, because he was very hawkish just a couple years ago. And then he shifted to being a little bit more, hey, let's go on pause.
There we go. We're getting that retracement. Now it's a matter of where do we hold.
So he is not just going to kind of like toe the line. He's an independent thinker, and there's a lot of substance with what he says. My concern is that really the time to have been cutting rates was April and May. And we might actually get some strength now to the overall economy because of the One Big Beautiful Bill. There's a lot of incentives in there for business investment. And so maybe some of the weakness that we have seen in the private sector labor market, which is what he's been focused on, not just the overall, which includes the public sector. So private sector payroll growth has really been lackluster. But now are we going to see a reacceleration as lots of businesses decide that, wow, 2025, we can take advantage of some of this 100% bonus depreciation. Let's really maybe launch some of these capital expenditure plans that we had put on pause for a while.
So it sounds like you think the balance of risks skews more. In other words, it is more risky to cut than to wait at this point, in your view, if I'm reading you correctly.
Well, I do think that the level of the interest rates right now is still restrictive. It's about more where are we likely to be come September, October, November. I think we'll see that reacceleration there. Now, I could be wrong about that. I would think that the balance of risks would suggest that shifting to slightly lower rates. I put the neutral Fed funds rate right now where maybe they should be at about half a percentage point lower than where they are. Right. So maybe that's kind of splitting hairs when you think about all of the errors in forecasts and also the volatility of the underlying economic data. But I could see maybe 50 basis points more of cuts and then that being more appropriate. So I would love to see the Fed do a little bit more of an adjustment. I think they paused prematurely, and I would like to see them kind of maybe course correct here. And so I'm pretty sympathetic with what Waller has said.
Interesting. Okay, so how is all of this translating into your strategy right now? I mean, obviously the Fed's not the only game in town. We still have the tariff headlines sort of hanging over the market to some extent, and we're in earnings season. So what does all of that equal for you?
Well, I think that it's really about we're towards the end of that storm, right? I think Jamie Dimon, was it a year ago or 2 years ago, lose track of time now, where he said, like a storm was coming. And then for a while we were in the eye of the storm. And now maybe we're at the back end of that storm in terms of the uncertainty, because a lot of that is going to be resolving, hopefully, by August 1st. Maybe there'll be a punting of that deadline for certain parties and the such. But once we get that type of clarity, I think that really then we'll see CEOs and CFOs no longer sitting on their hands, really thinking about what their expansion plans look like. Because right now it feels like they're kind of in survival mode, thinking, there's no reason to make any sorts of moves now, when if we just wait a month or two, that we'll get more information and can make a more informed decision. So I think that really I'm still positioned for growth in the overall economy, a reacceleration as we go towards the end of this year. And that argues, I think, for cyclicals like industrials, financials, and a little bit of perhaps defensives in there in terms of healthcare, just for good measure.
Brian, we did just get some numbers on consumer confidence from the University of Michigan. This was the July preliminary number, so the first look here at July, and it came in a little stronger than economists had forecast and stronger than June. 61.8 was the reading here. So seeing this sort of expectations for inflation ticking a little bit lower than they had been, what do you make of that consumer sentiment? We also, of course, had retail sales this week. So what's that picture looking like?
Sure. So if you think about the June data for industrial production and retail sales, stronger than expected, but some of that was just a bounce back. Now, the sentiment data, I think, is really important, especially the inflation expectations component, because I think that's one of the things that Chair Powell has been hanging his hat on in terms of justifying a pause, is that inflation expectations had been moving up, they're kind of high, and he wants to fight against that. And so if those are now drifting lower, really the argument for the Fed staying on pause kind of goes to the side, and maybe they should get to more of a neutral stance instead of a restrictive stance. And it's understandable why sentiment would have improved, because really I think we become a little numb to the tariff talk, realizing that this is going to play out. Maybe it's not going to be as bad as what it was originally presented back on April 2nd in the Rose Garden. If we settle somewhere between 10 and 15%, it's not great, but it could be worse.
So, Brian, as you look at all of these various elements, what do you think is the biggest risk?
The second 5 minutes are about to close, leaving us with 5 minutes on these 15-minute candles we're watching.
How much are you paying for those fundamentals? So as we go into earnings season, I expect that we're going to be seeing a lot of volatility.
Microsoft made a new low of day.
That are meeting expectations.
It's at that low.
Are probably going to get punished a lot more than usual. I don't think investors have the
Price is literally at our entry point from the last trade we were in.
Really interesting. Good to watch if companies
I wonder if we come back to retest the low of day and potentially get a double bounce or whatever it might be. This could be a higher low that it establishes, so that's also something I'm interested in seeing. Again, we're in the last 5 minutes of these 15-minute candles we're watching. Tempted to go long here again for a quick scalp. We'll see. Looks like it might want to come down to a little bit more, retest the lows potentially. Gonna push back up here. Missed entry at 63.34. Going into the last minute of these 15-minute candles we're watching. This is largely due to what? What do you all see? Small caps, right? That's the one trying to push it up while tech is at the low of this candle. Keep watching that relationship between these.
Well, top takeaways is if you look at what shares are doing today, we had a very high bar to cross, and according to
New 15-minute candles here.
the stock is trading at around 40 times forward-looking earnings. That is double the S&P 500. They're up over 40% since the start of the year here. And even though we had that full-year guidance raise, it perhaps wasn't enough to satiate investor appetite.
Let's see where we hold.
They said the uncertainty of the macro environment has little impact on them, that they are largely insulated from a lot of that volatility. And then if you look at the content side, they are doubling down on sports, they're doubling down on live content. They are reportedly in conversations with Spotify for a concert series. There are still rumblings about whether or not we could see Netflix bid on UFC media rights. It was sort of mentioned on the earnings call. They skirted around it a little bit, but we have the live component that seems to be a potential growth driver here. And then you also have really strong scripted series, the return of Stranger Things, Wednesday, Squid Game just debuted last month, and that's been one of the top performing shows on Netflix. So there seems to be a lot of momentum right in the current moment, but investor expectations are certainly high, which is why we're seeing shares down today.
Yeah, Jason, let's dig into that a little bit. I know you wrote in your note, looking at what has happened here, you're not really surprised by what's going on with the shares today. But given the underlying, picture that we just heard Ali paint, that the underlying story still seems pretty positive. What's your take?
Yeah, no, I think it is positive. I think this is a question of why the multiple expanded so significantly over the last 12 to 18 months. And in order to maintain that multiple, you have to give the street confidence that the growth is going to sort of stay at this sort of mid-teens level. And I think that's where there might be some investor concerns. Just to give you a few numbers, I mean, when they rolled out the ad tier, RMAS said they would get 80 million subs globally from that lower price. They probably have about 30 million of those subs so far. So there's still 50 million to go. But as the subscriber base gets bigger and bigger, 250 million, 300 million, if you're only going to get 50 million incremental subs, it points towards potential subscriber slowing down. And the second point I would make is a lot of the analysts, I think rightly last night, were asking about what is actually going on with your viewership in the US, where Netflix has sort of been flat at 8% of all US viewing for the last 2.5 years. And YouTube has just taken off, moving from 8% to 12. And so there's sort of an existential question here as well, which is, maybe Netflix won the pay TV war, but is it going to win this sort of ultimate war for consumers' time? And that seems to be shifting towards these open platforms.
So Jason, is that why we're on the sideline?
2 minutes left on the first 5 minutes of these candles.
Be number one in this larger streaming landscape, or is your neutral reading more rooted in that valuation concern?
Oh, no, they're definitely number one. They've been number one for a very long time. I can't think of a time when they weren't number one in the streaming wars. What I would say is that I actually think what's happened is portfolio managers that have been long sort of Mag 7 stocks began to look at the landscape and say, hey, wait a minute, I've got some of these big tech companies have AI threats. Some of them have DOJ threats. Earlier in the year, the market was nervous about a recession. And so the PMs began to look for, give me a stock that doesn't have AI risk, that doesn't have recession risk, that doesn't have DOJ risk. And Netflix checked all those boxes. So it was sort of a safe harbor, and that caused the multiple to expand, but it wasn't really underpinned by sort of parallel acceleration in the top line. That's why we're neutral.
Got it. And what could Netflix do? I mean, I guess, the share price is sort of out of their control, obviously.
Sure.
But in terms of operationally, are there things that they can do? I know that the company has said it prefers to grow internally, doesn't prefer to make acquisitions, but do you think that would be a good avenue to take for them?
Well, I think the boardroom level discussion has to be, does Netflix want to pivot and sort of embrace user-generated content? They obviously care about time spent on the app. That's why they've moved into video games. Not a lot of success there so far. But the question is, if you're sitting there at the boardroom and you're watching YouTube go from 8 to 12% market share over the last 18 months, do you begin to embrace UGC content? They could do that in sort of a half-step way or go all in. The half-step way would be to take some of these famous content creators and give them their own Netflix show and try and lean into that. The full-throated way is really more of a strategic pivot and try and take on YouTube directly by actually
Order filled.
Up user-generated content on the app. That's the central question for the board.
Ali, go ahead and get in here.
And Jason, Yeah, I wanted to ask some follow up there on UFC media rights. I mentioned that when I was talking about some of the takeaways here, and they still seem to skirt around the idea of live sports content. Do you think they need to double down on this considering the success we've seen on the WWE front?
Well, I think they need to move into live content to a greater
Order
extent.
filled.
I think the challenge is a little bit. The challenge, I frame it this way: what because Netflix is distributing
No, got a
live
horrible fill on my
sports,
put
bringing
position
in
here.
live content
Oh
is going to be
my.
one of our flaws.
I entered,
So what's
I had
happening is that
entered
when you
before
have
that
live
spill,
sports
and it
content,
literally closed me
people when
at
they come back to Netflix, they're going to
a
be looking
quarter of
for
a point
live sports content
when I
rather
could
than
have
seeing
caught, what is this, like a
the types of
3 point
content that
spill.
Netflix is offering. So of course,
That
as you
is
know, the only
horrible.
reason you're
That is
doing it is
horrible. I had
because
my
you
entry at
are
63.34.25.
working with a platform.
We
So
hit a
yes,
low
it's more
of
accessible for sports
63.30.75.
rights,
So at least two solid
where
points that I missed out
growth
on
is
there. But
maybe more
it
muted,
is what it
but
is.
even the
We took a
smaller
$12 gain. We're at
it's
190
a
for the
mature
day.
sport. So if you have any sort of
Jeez, that was
live
such a bad
sport
fill.
like UFC, that's really not going to check the box because Netflix is going to want to do a 10-year deal or a 20-year deal to insulate itself from the lift in
There we go.
viewership
We're
that
getting a
Netflix
bigger
is
spill. Now I just
generating.
feel
And
even
so the question is, when you look at
worse.
all this growth, what seller of sports rights is going to
Jeez.
acknowledge, yeah, my sports is really
Oh
matured,
man, that would have been a
and
great
and
catch.
therefore we can
But
move
we're
into
coming right back
not a
up.
customary 5-year deal, but a
Hmm.
10 or a 20-year deal. That's the threshold question.
Good point. Jason, great to see you. Thank you so much for joining us. Allie's going to stick with me because I want to turn to another media story that is getting a lot of buzz, a lot of discussion this morning, Allie, as you know, and that's the decision by CBS to cancel the Late Show with Stephen Colbert. This was announced yesterday, and it's going to be effective, I believe, in May of 2026. Now, CBS says this was for financial reasons, but Colbert recently has been quite a critic of the parent company, Paramount, and of its decision to have that $16 million settlement with the administration over their editing of a Kamala Harris interview. You know, so it's just it's hard to pull out the threads and figure out what was exactly behind this, Allie.
Remember, we talked about the potential retracement into the lows, right? And a potential double bounce. So this is what I want you all to keep an eye on is the low there, the low there. So where do we start consolidating here? Do we build a double bottom and push up, or are we going for new lows? That's what you want to watch for.
Needs regulatory approval. That's DC, that's Trump. So there have been some talk, I believe, since Colbert was critical of Paramount's settlement. He did call it a quote bribe just earlier this week, that maybe that was a factor. They're saying it was more ratings and trying to clean up their balance sheet ahead of this transaction. Now, Paramount shares are not doing too much today, pretty much trading flat to the downside, just a smidge there. But, you know, it begs the question of what's the future of linear television? What's going to be the future of these late night shows? Across the board of these legacy media companies, we've seen a lot of consolidation, a lot of turmoil. Warner Brothers Discovery plans to spin off its linear cable networks from its studio streaming business. NBC Universal, they're going to spin off a portion of that company, the broadcast arm in a new company called Versant. That's going to be the cable properties there. So the big overarching question is who is going to be a buyer of these assets, and what is Skydance going to do once this deal is complete with CBS and some of these other broadcast and legacy networks. So that is the big question here. Yeah. Paramount's not immune to this, but definitely a shakeup here when we look at the Colbert Show and just the legacy that it's had.
And we still don't know when and if that FCC approval is coming for that deal, right?
Yeah, still TBD there. That's the big cue. I mean, there's so many questions here when you talk about the entertainment industry, but for Paramount, that has been through the ringer here when it comes to even finding a buyer. Now that we found the buyer, we just have to get that deal approved. And you would think that we're now in a time where M&A is starting to happen a little more quickly, that we will see that by this year, but we still don't know when the sign-off is going to be there on the regulatory front.
We'll be watching it, Allie. Thank you so much. Coming up, we got to check on some of the biggest movers of the morning, plus what Congress's passage of crypto legislation means for that sector. Stay with us.
Hovering right back at the low of days. SPY about 9 cents away from making a new low. IWM just spilled into that new low. We should have held that downward position, but it is okay. Let's see, they've all made new low of days now. So if you're wondering what caused that pullback, it was an announcement first, Trump talking about tariffs, right, with the EU, saying he was looking for 15 to 20, and then a follow-up comment stating that the U.S. is looking for reciprocal tariff rates above 10, meaning that even if we have a deal in place with a country across the board, we're looking for that. And to my understanding, that's what causes little shakiness. Let's see if that's the low and we bounce back, or if we start to edge down.
Hi, I'm Allie Cannell, and I'm live at the NASDAQ, and we are about an hour into the trading day. So I want to take a look at where the major indexes are trading, and pulling up the Wi-Fi Interactive here, we're seeing losses across the board. The Dow is down about 0.4%, or roughly 150 points. The NASDAQ essentially flat. Same with the S&P. NASDAQ maybe down a little bit more, and this comes after both the NASDAQ and the S&P hit record highs on Thursday. Now, over the 5-day period, we are set to close in the red for the Dow. We'll see if we can turn things around here. The NASDAQ and S&P, though, they are set to close in the green over the week, and the NASDAQ over the past 5 days up over 1%. Same with the S&P 500 up more modestly, 0.6% here. Now, I also want to flip over to some crypto names. We have the Genius Act. This is that regulatory framework for stable coins set to be signed by President Trump later this afternoon. And we are seeing a reaction in some of these crypto adjacent names. So Coinbase, Robinhood, these are two names that are trending on Yahoo Finance right now, and they are both up over 5% on the heels of this news. And of course, this comes at Bitcoin prices are continuing to trade at all-time highs of around $120,000 a coin there. So I'm going to send it back to Julie in the studio. So right now, Julie, looks like red across the screen when it comes to the major indexes, but still some individual movers and crypto seeming to be a big benefit here with the Genius Act set to be signed.
And I guess it's an options expiration day, so that causes some bouncing around sometimes a little bit as well. Allie, thank you. Appreciate it. Now time for some of today's trending tickers. We are watching Charles Schwab, Union Pacific, Norfolk Southern, and Sarepta Therapeutics. First up, we're wrapping up a big week of bank earnings with Charles Schwab. That firm topping estimates boosted by surging trading revenue and reporting client assets at a record high $10.76 trillion. Retail investor activity exploded during the quarter as the market rallied. Schwab reporting that it had two of its busiest trading days ever during the quarter, saw over 1 million new brokerage account openings, the shares up 3%. And moving on, Union Pacific is in early talks to acquire rival Norfolk Southern, according to the Wall Street Journal. If you look at Norfolk's current market value, it's about $60 billion. So if it closes, it would be the largest rail operator in the country combined. Norfolk shares rising on the report, while Union Pacific is edging slightly lower. And then finally, Sarepta Therapeutics reporting that a third patient in its early-stage gene therapy drug trial has died. The company says it told regulators about the death, quote, in an appropriate and timely manner. But the news comes just a day after Sarepta announced a restructuring of its business that included cutting about a third of its workforce, as well as $400 million in annual expenses. It said at that time it would keep this drug on the market and continue to have warnings associated with it. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, the House of Representatives passing several cryptocurrency bills Thursday with bipartisan support. President Trump is expected to sign the so-called Genius Act into law, and the Clarity Act has advanced to the Senate. This comes as crypto's market value exceeds $4 trillion combined. Joining me now, Adam Kovacevic, Chamber of Progress founder and CEO, who represents some of the folks within this fintech industry here. Adam, I know that we've been talking about this thing for weeks now. There's been a lot of anticipation, both amongst members of the industry as well as in the price. But what does this thing do? Why is it such a big deal?
Well, let's start with the Genius Act, which the president's going to sign today. People may forget this now, but we had a big crypto stablecoin meltdown in 2022 with Terra Luna, an algorithmic stablecoin that was not backed to $1. That was the original impetus for the legislation that's going to be signed today, which requires that stablecoins be linked to $1, which is great for consumers and the stability of crypto. It kind of weeds out some of the less stable stablecoins, if you will. And so I think that's the significance of that law, of that bill that's going to become law today. Clarity Act is really much more about providing a clear division of labor between government agencies, between the SEC and the Commodities Futures Trading Commission, on who will regulate which parts of crypto. And that really starts in motion rulemaking processes for both of those agencies, which I think is really kind of a page-turning moment from the Biden administration approach, which was really to try to put their fingers in their ears and kind of pretend that crypto didn't exist and would go away, which I think was just a flop of a strategy.
Adam, I'm always curious, especially when we have a new technology that's starting to take hold, whether it's more of a push or a pull. In other words, there is a big industry that has now grown up around crypto and around stablecoins specifically that is really wants to forward these products. What's the demand?
Just hovering at these lows. Remember, we said if we went downside, the first stop that we're eyeing is 626 on the SPY. A little bit further down, 557 on Q's Tech. IWM pretty much at the initial marker that we talked about, 222. So we're, about a quarter away from that? 25 cents. Keep an eye on them.
Try to do with regulation is try to minimize the flops and make sure that those don't have a negative impact on consumers. But I do think, I sort of think like with decentralized technology, we've talked a lot about the need to kind of
Tech's been the one holding up better.
technology, blockchain technology provides that. But I think this industry, we're still in a pretty early stage for kind of seeing how that will be applied in new ways. So, this is really just the beginning in my view.
Well, to that point also, we spoke yesterday with Representative Mike Haradopoulos, Florida congressman, who talked about the significance of this vote as well. He says he sees crypto crucial to making the U.S. the epicenter of finance. I want to play what he had to say.
This is the future of finance. It's a more efficient way to move money, and it should reduce overhead costs for everyday businesses. That's what really makes the difference. And what was happening is that there's investment dollars were going everywhere else in the world because this is where people want to go with their money.
So again, to sort of drill down on this, Adam, I hear a lot of people using that phrase future of finance. He talks about the costs being lower. So sort of how is that going to play out in real time, recognizing, as you said, that it is early?
Here's the thing. So one of the things I think is important to understand about the political debate around this is that there are absolutely some crypto, strong optimists like the representative there, right? This is going to change finance forever. I'm actually more interested in the policymakers who may even be skeptical about crypto. And part of our argument to them is, look, you can be skeptical, but you should still want this industry to stay in the United States and be regulated here, right? Let's actually put this industry under the regulatory purview of our agencies, because if we don't do that, these are companies that will shift offshore, right? And we want crypto as an industry, frankly, to be subject to U.S. regulation and, frankly, following kind of American values. And so that's kind of my argument to crypto skeptics, right? That, even if you don't, you're not crazy about this industry, it's in America's national interest for us to be setting clear rules for this industry, protecting American consumers, and making sure that crypto as an industry doesn't just go offshore, where frankly it's further out of the reach of our law enforcement agencies.
Adam, I want to ask you about something else that you've actually written about. When we talk about the sort of sketchy reputation that crypto has had historically, and as you point out in a recent piece, this goes all the way to the top, right? With the Trump family that has been hawking a lot of what I think we can agree are at times dubious products, right? So how do you see that track at the same time that you see this legitimization push when the call is coming from inside the house, so to speak, that it looks like that there is abuse in plain sight?
Unfortunately, I think the Trump family's activity in the crypto space has just complicated this whole debate unnecessarily. Because I think if you ask people in the industry, they're going to say, look, we really appreciate that Trump kind of knocked off a lot of the silliness of the Biden era SEC and kind of Gary Gensler's approach, where sort of like pretending crypto doesn't exist. He's taken some good deregulatory steps. He's taken some steps to reduce, eliminate the lawsuits that were really silly. But at the same time, I think if you gave truth serum to most of the people in the crypto industry, they would say they would really prefer that Trump and his family weren't doing any of this stuff, because the fact is, everybody in the industry really wants a legitimized, regulated industry that's on firm footing. And that's what's interesting about this policy debate. This is not an instance of industry coming to Congress and seeking deregulation. They've actually been seeking regulation, more rules. And, I think the reality is the stuff that Trump's been doing has been sort of hanging over that. There are good separate bills in Congress that I fully support that would actually prevent presidents, members of Congress from being involved in things like meme coins. I think we should pass those things. Probably won't pass them unless Democrats take over one of the parts of Congress. But I think my view is that policymakers should be both pro crypto and anti-corruption.
And Adam, finally, I know you're not really a price guy, but I'm going to ask you a price question anyway. I'm curious. We obviously have seen all of this be very bullish for crypto prices, not just Bitcoin, but really the whole universe. From the people you're talking to in the industry, do they see any sort of other speed bumps ahead?
You're right. I'm not a price guy, and to be honest, to see your reporting about what the impact of these legislative developments are having on crypto stocks is interesting. frankly, I think the bigger point for me is what it does for consumers. And I think all of these things, all of these laws are positive for consumers, not from the perspective of necessarily crypto adoption, but from
Order filled.
Consumer protection and just more rules in place, right? Because I think what the long-term effect of all these regulations being passed is that you will probably see some less, some of the sketchier practices.
Went log again here, just a quick snipe. There we go.
Order filled.
Took another 37. What was it, like half 0.75? So 3/4 of a point. We're up to 222 on the day.
Where they want more legitimacy, more consumer confidence, and regulation is actually a path to getting there.
Adam adeptly handled the price question. Good to see you. Thanks so much for joining us. Appreciate it.
I missed out on the potential to grab it at the low here. Was just doing some quick workouts as we watch the market here, but that was my bad. Could have gotten a little bit more out of this, right? And even now, it looks like it's coming right back up to where we dropped. So eye on that. Feel free to ask any questions if you have them. If you wanted to join the group, get a little bit more in-depth information, remember that we do have a Discord. It's completely free for everyone, so there's no sort of fees attached to it. It's literally a library. That's what it's intended to be. A space where we can all meet, study, research, work together. So feel free to join that. All of the links should be active within the descriptions, whether you're watching on YouTube, Twitch, or X. Definitely invite you to join and just let us know how we can continue to help you. Let's see if we hold this bounce here. If we do, what I'm looking for is an entry or a long position into the previous high of day, which would be a take profit around 10 points from here at 63.40 would be my main target.
Seeing market share conversations. So my view from what I can see about the consumer, healthy or not, the U.S. consumer is overly resilient. You and I always talk about that. And what we're seeing even in the most discretionary of categories, even in the companies that I tend to look at, there are companies that are gaining sales. There are companies that are doing it, and they're doing it at higher profits.
Let's talk tariffs as well, Simeon. I'm curious, what kind of tariff-related margin pressure, Simeon, do you expect to see in your coverage universe?
So listen, I think the interesting thing that we have to acknowledge, tariffs raise the cost of goods.
New 15-minute candles here.
That with tariffs come immediate price hikes. It's just not true because in discretionary retail, right? Because the consumers need to accept those prices. And if you demanded 20% off for a pair of jeans last week, I promise you're not going to all of a sudden say, okay, I'm willing to pay full price because of tariffs. So what we're seeing with tariffs are listen, you have three different options. Either you can price it along, because the easiest way to mitigate a tariff is to raise price. The problem is it's very hard to raise price. So you're seeing certain companies raise price, and by the way, do it surgically. Nike is raising price on certain shoes, but not on others. The alternative is to say, okay, I can't raise price, or I can, but let me find a way to save elsewhere. So let me cut costs. Let me actually take margin savings that I would have otherwise told you about, and now feed them into tariffs. And then the third option is you have to absorb it. And we're going to see all three, right? It depends on where you are, because what we are seeing right now is obviously companies are going to have to entertain tariffs. Now, I do still think that the biggest problem with tariffs is more so the uncertainty of them than the severity of them. They're pretty severe, but all the companies I talk to, they know exactly what they're going to do when they're told what the tariff is going to be, but they're not sure which plan.
IWM, again, the one showing more weakness.
Simeon, where should retailers be making product? We know where the president wants to make product. He wants to make it here. Should it be here? Is it Asia? Is it Latin America, Africa? Where's the smart place to make the product?
So at the risk of upsetting the political sphere here, where should they make product? The place where it's most economical, right? It's as simple as that. Finding out where is most economic is going to be the hard question. And so that's this point. I've been talking to a lot of companies that will say, okay, am I supposed to pivot? So in the last 10 years, the playbook was pivot out of China, go to Vietnam. Well, obviously that's not such a great answer right now. So now people talking about Mexico. Well, then that pivots. Then it's Brazil. Then it's for the product that you and I want to buy at a reasonable price, you need to find a place that's going to be able to do it at a cost that you're going to be able to sell it at. And so that is this dance that people are trying to figure out. Once they know where these costs finally settle in, people then have to recalibrate. The companies will have to then move around their manufacturing and figure out where can I do it to get the best quality at the best price, because it's not just the best price. You still need it to be quality. And that's this dance. And so I don't think there's an answer right now that people can say, I know exactly what country I'm supposed to move to. And I think that's what makes it so difficult.
So the dance continues. Meanwhile, Simeon, you have to make recommendations to your clients. So let's get to some picks. Nike, you got the equivalent of a buy on that one. How come, Simeon?
I think, and you and I have talked about this in the past, I think with Nike, what we're looking at is the exact problem that they faced a decade ago. And so to your point about tariffs, Josh, I need to look at these businesses and say, if the easiest way to walk past a tariff is to be able to raise price, then all that means is I need a company that's able to raise price in general, which means I need a company that has brand equity. Nike has brand equity. And so this thing, my team did a really fascinating report, and I'm appreciative of them for it. But we look back a decade ago when Adidas started taking mind share from Nike with the Ultra Boost, with the Yeezys, with the Gazelles, with the Sambas, with all of these things. What Nike did, they went back to their archives, they flooded the market with Jordans, which is exactly what happened now, and then they came out with a competing rhyming product to that Ultra Boost. It was called the Epic React. Right now, Nike's been dealing with the same issue. They watched Hoka and On and New Balance and all these brands that had created a big max cushion that's product that Nike didn't have take mind share. What did Nike do? They went back to their archive. They flooded with Jordans, with Dunks. Like this was the same thing that happened, but they needed a competing product. They didn't have it, and now they do. And so as of the last earnings call, Elliott Hill, the CEO, talked about this new line, the Vomero 18s, did 100 million, 90 days. That's a good start. And so do I think we're out of the woods? Certainly not. Does it look like we're troughing earnings? That's what it looks like. And if that's the case, then people start cycling into Nike's earnings power. And so I think Nike, you have this big business that's obviously very ownable that becomes really interesting. I think on the other hand, there's some companies that are a little bit smaller that really are lying in the dirt from an investor valuation perspective that look interesting. I think a Capri, which owns Michael Kors, just sold Versace or is in process of selling Versace and owns Jimmy Choo, is a company that had a very dirty looking balance sheet, but with the sale of Versace will look very clean. The multiple doesn't reflect it. So I would look there. I think a Bath & Body Works, which is finally, as ironic as it sounds, seemed to be finally cycling through a a pandemic overhang, like we saw with Peloton, like we saw with grills, like we saw with home patio furniture, where people overbought things during the pandemic. People overbought candles. They overbought soaps and sanitizers. It lasts a while. But as of last quarter, you watched revenues grow. You're starting to see that change. Look at the free cash flow yield. It's not reflected in the stock. So different types of stories. These are a little bit more, you have to go down and dirty and look for value. But I think there's interesting dynamics here across the market, where on the other hand, I have plenty of stocks that are trading at their all-time highs.
I only have about a minute left, Simeon, but I want to get this one in. Here's a name where you don't see value. There's only one sell, I think, Simeon, in your coverage universe. That would be Ralph Lauren. How come?
Listen, I think Ralph has done a great job. Ralph is one of the ones I referenced that trading at their all-time highs.
All right, I have a few meetings coming up here, so I'll be off the mic for the next hour or so, but stream's going. You'll have Yahoo Finance to take care of you.
This has run a lot. And so I think when
All right, I'll see you all in a few. Guys, didn't notice that Yahoo Finance had paused.
Considering firing Fed Chair Jerome Powell. That spooked the bond market. Ultimately, Trump walked back those comments, and now we have those levels that are settling in closer to what we've seen over the past month. But the 30-year yield, it's trading at 5%. This is a key technical
Going
level
into my
to
last
watch,
meeting, and then
we know
I'll
that
be
the
back
market,
on in about
both
30 or
equities
so
and the bond
minutes.
market, they're susceptible to a lot of these developments on the Fed front. So something to keep an eye on. Also, let's keep an eye on the dollar, because we are still below that psychological 100 level. The U.S. dollar index has just struggled so far this year, and this index tracks the dollar's value against a basket of other major foreign currencies, and we are down about 10% since the start of the year. But I will say that that is helping certain companies this earnings season. Netflix, for example, recently raised their
Order filled.
guidance, and they did cite the help of the dollar and the fact that that is depreciating when it comes to some of those international sales. So something that we're going to continue to track this earnings season, and we will keep tabs on the market moves here on Yahoo Finance later on in the session.
Now let's get to some of today's trending tickers. We're watching Humana, Chipotle, and Roku. And our senior markets reporter, Ali Canal, is still with us live from the NASDAQ. First up, let's get to Humana. It's falling after losing a lawsuit over Medicare payments. It's going to cost the company. The health insurer sued to try to undo cuts to its Medicare bonus payments, hoping to restore billions of dollars in revenue. The government had lowered Humana's quality rating, which means the company gets less money from Medicaid starting in 2026. A Texas court voted to dismiss the case. Down 2% here is what we're seeing for Humana shares. And Ali, we've also seen some pressure on other companies within this industry.
Yeah, if you take a look at some of those competitors in the space, Elevance Health, Molina Health, they are also under pressure today. At last check, I believe they're both down around 5%. Now, Humana,
Order filled.
is down over 2%. We are a little bit higher than some of those session lows here, but the decision had been a setback in what was a really high stakes legal case, one that could have added billions to Humana's bottom line, like you mentioned, Julie. And digging into this, it was interesting because the challenge was this downgrade to its Medicare quality ratings. Now, this would have reduced the number of members in bonus eligible plans, and that's a big deal because these star ratings, they help determine how much money insurers receive in bonuses. And for Humana, that's core to their business. In 2024 alone, they took in $2.5 billion from these payments, and according to Barclays, a win that could have added nearly double to Humana's 2026 profit outlook. But the judge ultimately ruled that this case was premature, suggesting that the company needs to complete the administrative appeals process first. But just really underscores the broader challenges here facing some of these government-backed insurance programs.
Yeah, definitely. And we could see that process continue, by the way, legally. So this story might not be over. Coming up next, let's talk about Chipotle. It's getting an upgrade to outperform from market perform at BMO Capital Markets. The analysts, they're saying the restaurant chain sales and profits should pick up in the second half of the year, and that the U.S. expansion still has lots of room to grow. The firm's setting a $65 price target, implying 21% upside for the shares. The shares, Ali, not getting that much of a lift from this call.
Yeah, we're just up around 0.4%, and it's really the second half that BMO is focused on. They pointed to accelerated same-store sales and margins. Analysts noted that comps are starting to and says that Chipotle's U.S. growth strategy could eventually hit a 10% annual pace. Now, what was interesting in this note is they also said Chipotle is well-positioned even if the economy slows. And we've been talking about the state of the consumer, and there seems to be two different camps here, the high-income consumer and those that are still struggling with inflation, and that's hit a lot of those consumer-facing names, a lot of these fast food chains. Chipotle shares, by the way, they're down about 11% since the start of the year. And I'm used to talking about how bullish people are about Chipotle. So we've definitely seen a slowdown on that front. But BMO is saying that its value proposition is best in class, which could help the brand continue to outperform peers on traffic along with revenue. So perhaps this call is a turning point for this company. But like you were saying, we're not seeing too much of a share reaction right now.
No, not at the moment. And finally, let's get to another analyst call. JP Morgan bullish on Roku heading into earnings. The firm says advertising is holding up, China tariffs are cooling off, both of which are positive for the company. So the analyst sees about 10% upside from the stock's last close. This one, kind of your bread and butter as somebody who has covered media here, Allie. And it's a stock that has had an interesting trajectory.
Interesting trajectory, especially within this market environment. If you take a look at a year-to-date chart, you'll see right around March and April where a lot of economists were coming out calling for recessions, Roku took a very serious hit. And that's because during any economic slowdown, what's first to go? It's those ad budgets, and that is really core to Roku's business. So we saw the stock take a hit there, but now we're up over 20%. And a big reason why is we had a lot of that uncertainty evaporate just a bit from this market. Their economy right now seems to be really solid. A recession is not the base case at this point. And JP Morgan is expecting, heading into the earnings season, that Roku is going to be in a strong position. They said that they were too conservative last quarter, and they now see platform revenue rising 15% in Q2. That's above current guidance. Also slightly ahead of forecast there. So we'll see if this name can deliver. But a lot of the gains that we're seeing now since the start of the year, that's stemming from that recovery from those April lows.
Allie, thanks so much. Appreciate it. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. 50% tariffs on copper imports are set to begin August 1st. It sent prices soaring and motivated companies to focus on domestic mining. Ivanhoe Electric is one such company. It's expecting to begin construction on a new copper mine in Arizona early next year. Once completed, the site would mark the first major copper mine built in more than a decade in the U.S. Joining me now to discuss, CEO Taylor Melvin. And you actually announced this project, Taylor. Thanks for being here. You announced this Arizona project several years ago before this latest round of tariffs. So at that point, what was the motivation here to get into this project and look at domestic production?
Well, thanks for having us this morning, Julie. Clearly, this project is a high-quality project located in Arizona, which is known as the Copper State, and it's important to note that this project is located about an hour south of Phoenix, Arizona, between Phoenix and Tucson, near the city of Casa Grande. And what really drives the value and the importance of this project is our need to produce more copper domestically to support domestic demand. So we've been advancing this project in earnest since before the company went public in 2022. And we are now in a great position to advance the project, and we're looking at an accelerated timetable that would have us starting construction as soon as early next year, which puts us on track to produce first copper metal potentially by the end of 2028.
So still a couple years out here. What could be potential delays? Because obviously this is something that takes quite a long time already to do.
Yeah, so you've probably seen a lot of news in the marketplace about how long it takes to find and develop and permit copper projects. One of the big advantages that we have is that our project is located entirely on private land. We own about 6,000 acres of land just outside the city of Casa Grande with excellent access to existing infrastructure. We've got water rights. We've got a power line that runs through our property. We've got natural gas. We're located close to interstate highways and state highways. Access for rail just to the north of our property. So we really don't have a lot of the challenges that are associated with longer lead time items. And certainly being on private land helps our permitting process. Our permitting authorities are the state of Arizona, Pinal County, and the city of Casa Grande, which allows us to have a much more streamlined permitting process, which is why we're available to talk about such an accelerated timetable for the project.
Taylor, mining in general and copper in particular has the reputation of being a dirty business. So what can you tell us about this particular project and any concerns about that?
Well, first of all, copper is one of the critical metals for our global economy and certainly our domestic economy. We need copper for every aspect of our economy. We need copper to generate and transmit electricity. We need copper for our automotive industry. We need copper for air conditioning, which is in Arizona is certainly critical. Copper is one of the most important metals that we have to support electrification and cleaner energy. So, that's one key point about copper projects. But certainly, what we're doing with a new project is we're able to incorporate modern mining technologies. We're incorporating renewable energy with integrated battery storage. Our project at Santa Cruz is going to be a shining example of a modern underground copper mining operation with a small surface footprint. And we're going to be producing clean, refined, pure copper metal for use in American industry. So it's really going to be a great example of clean, efficient, low-cost copper.
Taylor, why haven't we seen more copper projects in the domestic U.S.?
Well, for one, it's hard to find copper projects, but for second, a lot of the copper projects in the U.S. have been on federal land, and the federal permitting process has been a long process historically. And on average, most data suggests that to find, develop, permit, engineer, and build a copper project in the United States takes almost 30 years. That's what really highlights the value of our Santa Cruz copper project, is that we're so advanced in the process, and we're talking about construction as soon as next year and production and before the end of 2028.
2028, we don't know where copper prices are going to be, obviously. We don't know if tariffs are still going to be in place. But given those dynamics in the market, how do you make U.S. copper competitive do the tariffs make it more competitive on a price basis?
We don't know yet, to your point, what the tariffs are going to be, how long they're going to last. I would say that what's really important, though, is the strong support that this administration is showing for domestic production of critical metals, including copper. So that's a real important backdrop for us to have as we advance projects that we need to support domestic demand. So and when it comes to prices, certainly you've seen a run-up in the COMEX price relative to the London Metals Exchange price, and we certainly benefit from that dynamic. As a producer, though, of pure copper metal, and it's important to note that we're not going to be producing concentrate that needs to be shipped to a smelter before it turns into pure copper metal. As a producer of pure metal, we're not going to be subjected to these import tariffs. We're in a perfect position to be tariff-proof and to produce economic copper. I mentioned earlier that we're using modern mining technologies and renewable power and integrated battery storage. That allows us to have a very low cost profile for this project, low capital intensity. We're going to be producing copper at an average unit net cash cost of less than $1.35 a pound. Today's copper price, you can imagine, that's a very strong margin. So we've got an economic project at today's prices.
Yep, we got it right next to you on the screen there at 560 where it's trading right now, Taylor. So obviously that's a good gap between the two. And just for folks who are not familiar, copper concentrate versus what you all are producing, the places where that is made in the U.S., in some cases it needs to get shipped out of the U.S. to be processed and then come back in. Is there a sort of break-even copper price that you're watching here at which, because even though your cost to produce is low, you've had all these years of costs, so I don't know what the all-in cost is going to look like in terms of the copper that you guys are producing there.
Yeah, break-even copper price is a big subject globally, and it's very specific to the asset. And so one thing that's very important is to have a high-quality asset with a low-cost structure and a low capital intensity. Our project has an initial project capital of about $1.25 billion. And looking at that in comparison to the first 15-year average copper production of almost 72,000 tons of copper metal produced, it results in a very low capital intensity of around $17,000 per ton of copper produced. And I've already mentioned the low cost structure. So our break-even copper price is very low, much, much lower than today's prices. And in fact, our copper project is very economic at a $4 or $4.25 copper price. But globally, you touched on a very important point. The world needs more copper. The world needs large-scale projects, not just in the U.S., but globally. And those projects, because of their large capital requirements, typically do require much higher copper prices to justify the massive investments.
Taylor, really good to catch up with you. Really interesting topic, especially right now. Thank you for your time.
Thanks for having us. Appreciate it.
Well, we're watching the markets action coming up. Stay tuned. You're watching Markets Catalysts.
News about President Trump, it lit up global markets yesterday as headlines about firing Federal Reserve Chair Jerome Powell sent stocks plummeting as yields popped. On today's Stocks in Translation, we're going to look at prediction markets or binary market futures. And here's the definition. These are financial contracts regulated by the Commodity Futures Trading Commission that let you bet on whether a specific event will happen, paying $1 if it does and nothing if it doesn't. It's either or, hence the term binary. And here is a chart of Thursday's price action in the S&P 500 and what was happening in the prediction market. And in green here, we have the S&P 500. Just as the odds, as all those headlines about President Trump possibly firing not President Powell, he's the chair of the Federal Reserve, we saw those odds go up and we saw the stock market go down. It was pretty well timed here. And what's interesting is that stocks would manage to recover all those losses and actually close close to the highs of the day. But now I want to show you a second chart. This is the same prediction market versus the 30-year yield. And you can see here they were actually going in the same direction. And unlike stocks, the 30-year did not come back all the way down. In fact, it stayed above that critical 5% level into the close as it did the very next day. So there might have been some damage done there. And now I want to take a look at a longer-term chart of these prediction odds and the S&P 500. This goes all the way back to January 30th, and I'm going to show you the S&P 500 tanking here. I'm just kind of tracing that out here and recovering. And I don't think there's a longer-term correlation with these prediction market odds. So I just want to establish that right now. I do want to say that it's pretty interesting that the prediction odds have increased for Powell getting fired as S&P 500 has been hitting record highs. But those prediction odds, at least on a closing basis, by the end of the day, have never exceeded 25%. And intraday on Thursday, they actually hit 40%, but it never even got above 50%. So since we've seen a lot of these binary betting futures kind of rise in popularity over the years, I just wanted to show you a table that compares and contrasts them with auction markets. And so that's what we would traditionally call the stock market or the bond market or even commodity markets. So the first is a payout. In binary betting futures, we have all or nothing. That's $1 or zero. And of course, in the stock market, it depends on the per share price. And that can go up, it can go down, and it fluctuates on a minute-by-minute basis. And then another factor is price. We have for binary betting, we have the implied price change versus the current market value as determined by market participants in these auction markets, the stock market, for instance. And then as far as risk is concerned, we have a fixed max loss in the binary betting. As I said, you can win $1 and you can't lose more than $0, or you can't go down to more than $0. And in the stock market, things are going to fluctuate on a minute-to-minute basis. And then finally, the typical focus here for prediction markets, that's going to be on a single event. It might be what the Fed is going to do. It might be on Powell getting fired. It might be on an election. And of course, in auction markets, in the stock market and bond market, we just have this on an ongoing basis. So as we saw with last year's elections, sometimes these betting markets deliver accurate information that's more so than traditional polls. And with controversial decisions becoming the norm, these markets are only likely to grow in size. So tune into Stocks in Translation for more jargon-busting deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Tesla is set to report second quarter earnings results. Year to date, shares of the EV maker are underperforming the broader markets. Tesla's contending with weakening sales and a PR issue over CEO Elon Musk's involvement, not only in the Trump administration, but in politics more widely. So what can we expect from those quarterly results? Here with more, Yahoo Finance senior autos reporter Pras Subramanian. So what are we looking for, Pras?
Yeah, a lot on the agenda here, Julie, and I'm going to break it down into three key parts, right? So number one, let's look at the core auto business, right? All the money comes from car sales, really, right? They're expected to report Q2 revenue of $22.8 billion, a 9% drop compared to a year ago, and adjusted EPS of 43 cents. We've seen deliveries were weak in Q2. How much of that was because of the Model Y changeover? Is that top seller still available? Is it already available in most of the major markets? We'll see. You need to hear more on that. So number two is the robotaxi rollout, right? So this is good news, for them. Austin happening on schedule and now expanding. What's next for expansion plans in new regions? Musk said California was coming, but there were reports that no permits have been applied for yet, right? So, and what about the use of safety drivers? So, just going to have the person sitting in the passenger seat the whole time. Waymo is the undisputed king here with robotaxi, and we just saw that Uber's getting into space as well with Lucid. So, competition rising here. Finally, where's that cheaper EV, right? We a year ago, Tesla said it was going to come out in the first half of 2025. We haven't seen anything yet. Can we still count on it happening at all this year? Barclays' Dan Levy talked about how Tesla will probably push the launch or sort of reveal of that cheap EV in the fall after the EV tax credit goes away, right? As a way to sort of maybe gen up demand. We'll see, but even if it will, it's going to definitely come up on earnings today. When they report earnings.
Yes, July 23rd is when we are looking for those numbers. And Pras, the backdrop for this, of course, is that the stock is still underwater pretty deeply for the year. I think it's down certainly more than 15% on the year. And so there's not a lot of optimism. I mean, there's always optimism from the Tesla faithful. You and I know them well. But it doesn't seem like from the market writ large that there's a lot of optimism here.
Yeah, stock's down 20%. It was down 40% at the end of Q1, Julie. So there is a little bit of pairing of those losses. But yeah, you're looking at what are the upside catalysts for a stock that maybe it's sort of petered out a little bit. I mean, the bulls are all fully in, but Wall Street wanted to see what's going to justify that valuation. We talk about robotaxi rollout. Maybe we'll get more crucial information on there. But Musk was teasing. I regret to say he was teasing, or forgot to say that he was teasing a very dramatic reveal of a vehicle coming out later in the end of the year to show. He wants to show people this demo of something. We don't know what that is. Maybe it's that long-awaited new Roadster. But is it really going to move the needle? I think they need to really wow people out of the gate. Something like a Cybercab or something like of that nature that will actually come out soon. That will sort of move the needle beyond all the negative press that Tesla has with Musk and all the new competitors that are on the space that are actually competitively priced. So yeah, they need something that's going to really keep the stock afloat. Otherwise, it's going to be more and more about the weakening auto business.
Right, this thing that they actually do now instead of the things that they're doing tomorrow. Pras, thanks so much. Looking forward to that report. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We've got more Yahoo Finance coming up.
Are you ready to master the markets and, dare I say, become a better investor in the process? Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights and strategies from some of the most influential minds on Wall Street and the boardroom for key insights to help boost your portfolio, build your wealth, and make you a successful investor. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts.
It's time for Yahoo Finance's Market Minute. U.S. stocks fluctuating in today's trade, hovering near record highs. Wall Street keeping a close eye on trade talks as President Trump reportedly pushes for a 15 to 20% tariff on all EU goods imports. According to Financial Times, Trump would also be content to keep auto sector tariffs at 25%. Talon Energy shares are rising as the company expands its portfolio. The power producer signing definitive agreements to acquire Caithness Energy's Moxie Freedom Energy Center in Pennsylvania, as well as Caithness Energy and BlackRock's power station in Ohio. The net acquisition price is $3.5 billion, with Talon aiming to enhance its fleet with the acquisitions. Abbott Laboratories getting a lift at Jefferies, that firm raising its rating on that stock from hold to buy. Jefferies noting potential for growth to accelerate in 2026 for Abbott. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below.
Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right decision for your portfolio. I'm Jared Blickry, your host, and pleased to be back in action after a 3-week hiatus. And joining me, to be sure that we don't veer off too far into jargon land, is Yahoo Finance senior reporter Ali Canal. First, please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we're going to be talking about the markets and the economy through the lens of psychology, one of my favorites. Our phrase of the day is the wall of worry. Investors must face it, embrace it, and try not to chase it. And this episode is brought to you by the number 43%. That is the share of American adults who say money stress is hurting their mental health. We dig into money dysmorphia and how to confront it. And today we are welcoming back Callie Cox. She is the Chief Market Strategist at Ritholtz Wealth Management, a firm now guiding over $5 billion for global investors. And she's known on the street as Optimistic Callie, the voice behind the United States of relentless optimism and one of the sharpest reads on sentiment swings. Hello, Callie.
Hey, great to be here.
Thank you. To start out with, why don't you set the stage for us market-wise with all the conflicting psychological influence that investors are facing and weighing right now?
Yeah, it's been all about the psychology recently. And what I mean by that is, the stock market bottomed around April 8th. That was right after Liberation Day, the day when Trump brought out the big poster with all the tariff rates. And you had to squint to see them. I remember that very clearly.
You wrote a lot about it.
I did. I was following it like a hawk when it happened. But, since then, the market sold off almost 20%. Now we've rebounded back to record highs, and not much has changed except for the psychology and the mood of the markets. So it's really required a lot of attention on how people feel, how allocated they are to the stock market, if there's this sense of FOMO, which there is, bubbling up among investors. And that's really what's been driving stock prices higher. So I'm glad we're chatting about psychology today.
Me too. So let's get now to our phrase of the day, which is wall of worry. The wall of worry is investors' persistent fears about markets.
Let's
from
go.
Recessions to rate hikes, even as stocks climb higher again.
I am back on the stream here, guys. Finished with all my duties. Looks like we're inching back up, right? We're trying to push here. Everything right around VWAP. Let's see if we end up having this be the low of day, whether we run up, but potential additional long entry here if things hold up. I don't know if you all heard it, but while I was in my meeting, I did enter an additional trade, and it was literally this. If you wrong window there, it was this, right? It was just the break back to the upside. I caught maybe like a point and a half move there. So taking a look at my current gains for the day, I am up at a total of $267.50 for the day. So sitting at a pretty sweet spot. Don't really need to trade anything else, but this right here could potentially bring in additional break. So watching it very closely here, trying to determine whether or not it's worth entering this potential break.
kind of like ho hum. I'm just a little bit up, a little bit down. Doesn't seem to make much of a difference. But I know you have a burning question.
Well, I'm just curious when it comes to the vibes improving, the fundamental story hasn't changed. Why do you think the vibes are better now than they were even a month ago?
I think the vibes are better now because they were so bad back in
Okay.
April. I think right after Liberation Day, and you have to remember too, we had so much news around them. I think 150% tariffs on China were thrown around
Crazy.
for a little bit. And it's like we were all staring into the abyss. We were like, okay, well, recession is confirmed. I didn't say that, by the way. Some people were. But, everybody was kind of staring into this awful, awful worst case scenario. And then suddenly that was taken off the table. So it's almost like we saw a ghost. And now, now that we've seen the ghost, we cherish every day that we're not seeing it.
Yeah, it's a friendly
it's a
ghost.
friendly ghost.
But does that put the market rally that we've seen at risk of deteriorating, considering we still have a lot of unknowns and a lot of question marks?
Watching here.
does.
Watching here. Let's
When
see.
you
We
see
got
a
some
rally
news
this
come
strong,
out.
You want it to be confirmed by economic data and earnings data because the stock market ultimately
Nothing
drives
big.
higher on the economy and earnings. It's following corporate America's fortunes, basically. And we just haven't seen that. We've actually seen earnings momentum and economic momentum slow down since the April 8 trough. So I don't believe in a perfect rally. I don't think you can point to a checklist and say, okay, well, we haven't checked all these boxes, means we're going lower. I don't think that's how investing works. There's a lot of psychology that goes into it. But would I feel better if we saw it confirmed by earnings and economic data? Yeah, I would.
Not in a rush to go long here. I did miss my initial entry while I was in my meeting. I would have wanted to catch the bounce off of 63.27 on ES, but we're just patient here, right? We're at the neckline. And what I mean, the neckline is, take a look at this, right? It's the previous low before we dumped. It's the previous low before we dumped, previous low before we dumped. So we're right at the midway point between both of those steps down.
Which I think happened a week or two ago. Powell came out actually at this conference in Sintra in Portugal and said, a July rate cut isn't necessarily off the table. I think that's Powell's way of saying anything can happen. But of course, markets heard that and they said
2 weeks away.
They said, okay, so you're telling me there's a chance. So I think the rally we've seen over the past few weeks has been a little bit of that tariff relief. So a continuation of what we've really seen since April, and that's tech, consumer discretionary, that's materials, that's industrials, like a lot of the cyclical type sectors you can think of. There's also been a lot of optimism around a rate cut or lower rates coming. I think it's misplaced optimism because I'm not sure a rate cut isn't this big celebration that everybody thinks it is. But that's dissipated a little bit, I think, because of some Fed speak since then and some economic reports we got.
And also, the jobs report came in better than expected in a lot of ways, at least on the surface. But to your point, when we saw that better than expected jobs report, the odds of a July rate cut pretty much evaporated. So when you look at the rate cut path and how we might cut for bad news rather than good news, how should investors think about that?
That was my question, because you write about celebratory versus panic rate cuts.
Yes.
You got a lot of stats there.
Yeah. And this is something I talked about last year because I firmly believe that we are in the celebratory camp. The point where the Fed lowers rates because the economy is in balance and they don't need to have their foot on the brake too much anymore. I don't think we're there right now. The July jobs report was strong on the face, but it was strong because of some additions in state and local government jobs, which is great if you're a firefighter or a police officer.
73,000. That was kind of a surprise to me with all the job cuts that are going on. But you said state and local.
State and local government.
Different than government.
Which are being affected by federal government cuts, but that's not the cuts that you're reading about in the news.
Sure.
The breadth we're seeing in hiring isn't as strong as I would like to see, and it's concentrated a lot in education and healthcare, which is great, but those are the sectors that you expect to hire regardless of where the economy is. So, for you or me in a white-collar job, it's not as easy to find a job. We're seeing unemployment claims keep rising. People are clearly having a much harder time finding employment. And to somebody like me who believes that the job market is the foundation of the economy.
What are we all watching? Is anybody in any specific positions that you all want to cover?
It's just a matter of time before the market breaks down.
But do you think it's a good thing that layoffs aren't happening? You were talking about corporate America, and at this point, we're not seeing companies aggressively lay off workers. they're having a hard time finding a job if they're out of one, but at least for now, those that have their positions are able to stay the course.
Well, there was a pickup in layoffs that we saw around March and April, even in private sector jobs. So we've seen government layoffs pretty much throughout the year. There was a spike of those in February and March, and we expect to see another spike in September or October when a lot of those layoffs come off of admin leave. They're not paid anymore. We've definitely seen layoffs tick up in jobs data, in private sector data. The layoffs were a little calmer in June, but the March, April, May timeframe was really rough for corporate America. Clearly, it hasn't pushed us to a breaking point yet, but I think it's getting to the point where the Fed may not have a lot of time on its side. And look, I don't know what the future holds, but I do know that when the job market breaks, it breaks quickly.
Yes,
So
it does.
the Fed might find itself, a little behind the curve here in lowering rates and giving us the breathing room or giving the economy the breathing room that it needs.
All right, so we've been talking about job market breadth, and I want to talk about market breadth because here's an interesting stat. 43% of S&P names, S&P 500 names are beating the index this year. So that's only 43%, and that amounts to what you're calling a skinny bull market. I love the term, but a skinny bull market means that we don't have that large breadth of participation. How concerning is that to you?
Yeah, well, we've had a skinny bull market since the beginning of it in 2022. I think
Like the mega cap dominance.
Yeah, it's the mega cap dominance. It's the Mag 7 that you hear about all the time. Again, it's not something that is ideal. When you see a bull market, you want all stocks participating. That rarely happens, but usually you see a majority of them moving higher, and that just hasn't been the case this time around. Part of it is because the Fed hasn't really cut rates. It was hiking into the beginning of the bull market. You rarely see that. I think it's only happened one other time in recent history. And because of that, the Fed has effectively put its foot on the neck of the bull market. It said, okay, we want you to exercise restraint in the economy, in your portfolio, but at the same time, the stock market has fought to move higher. It's just done so in a very bifurcated way. And we're still there, even though 43%, believe it or not, is a better showing than last year's 30%, and the year before it's 28% of S&P stocks beating the market. So, we're really in an environment too where I think technicians have a lot to be excited about, but economists and more fundamental. Yeah, I'm speaking to one right now.
So one more question on the wall of worry before we go to break. What cracks the wall? What's the Humpty Dumpty moment when there's a fall and there's a tumble and when you don't want to chase that wall anymore or climb it?
Yeah.
What are the cracks in the chinks in the armor that you're looking for in the economy or the market?
The big crack is the job market.
Okay.
I think tariff policy could also push us there. I think there's an element of the market kind of pushing on the taco trade right now. This isn't really going to happen. Trump isn't really going to implement these tariffs on August 1st. As we saw in April, that mirage is basically gone. Like maybe he will go for it. So I'm afraid news that dramatic could push us over the edge. I also think inflation is something to watch because we still haven't seen tariff-related inflation really flow through to the reports that we watch, especially on the consumer side.
And we will be getting CPI data as soon as this episode drops, so be tuned to that. We need to take a short break, but coming up, we're going to be talking money dysmorphia and a runway showdown featuring vibes versus reality. This episode is brought to you by the number 43%, another 43%. This is the share of U.S. adults who say money stress actively hurts their mental health. And this is according to a recent Bankrate survey, a big red flag for the growing problem of money dysmorphia. And this is, I'm going to define this for you. Money dysmorphia is a distorted perception of personal finances, often leading to...
All right, let's see if we get another bounce play here. We keep dipping, at least on ES, between about 63.25 to 63.27-ish, and we just keep bouncing. So there's some sort of demand there. It is the low of the previous drop, so let's see if we hold.
Katie Gatatasan, shout out to you, but it's this term that describes people who have a different financial situation than what they think is the case. It's like looking into a mirror and saying, you know, I look a certain way and other people see it a different way. I wrote about it because I have a certain form of it. I'd say it's probably on the milder side now because I've worked on it. But, you know, as a child growing up, I didn't have a ton of money, and it, you know, my childhood really set some benchmarks in my head. Especially money-related benchmarks that made it harder for me to really adapt to adulthood and making a paycheck and, you know, understanding what it costs to live. And it's something I've been struggling with for a while, and I think about it a lot because whether you realize it or not, your risk tolerance is really set in your childhood and how you learn about money. And that's an almost insurmountable battle as you get older, especially, you know, as you start...
A very interesting conversation we're hearing here.
You know, people
Kind of
talk
true.
about where the market is going all the time, and I think that's important. I think education is important, but there isn't enough conversation around this piece that matters so much to how you think about money.
What tools helped you the most, whether it be books, resources, to help you overcome a lot of that battle?
Therapy.
That was the answer I was
Yeah.
going to go for. But
Therapy, go to therapy, even if you don't think you need it.
then you probably do.
Well, then you probably need it more than anybody. But seriously, go to therapy. I hate that there's a stigma around it. I've been in therapy for years and years and years now. But one thing that helped me was understanding what normal is. Because as a child, you have a very warped perception of normal. You basically have what adults put before you, and you say, okay, this is my normal because I know nothing outside of this bubble. And then you kind of grow up with that in mind. And then you get to your adult years, you get to your 20s, and then suddenly you're almost redefining that normal. And getting into therapy, talking with an objective person or a party really helps you nail down where you've kind of gone off the range a little bit. So I've found a lot of help in talk therapy. I love to talk too, so I mean, go figure. But there are some really good books out there that can help you too. Psychology of Money is one of them.
I like that, redefining your definition of normal at each stage of your life. That's probably an important one. How about social media? How has social media impacted money dysmorphia?
Yeah, good one.
Yeah. It's
Fighting the urge to want to go long here again.
tempted to say
Just
be
being
better. And I
patient.
think
Could be a good
talk
entry.
about money more, then yes, you know, social media is for the better. If we all feel comfortable sharing our stories and sharing our experiences with money, I think everybody wins. Of course, there's also the side of being able to see how other people live and, you know, seeing a highlight reel of somebody else's life that may not be reflective on how they really think or how they really live. I think that's damaging. But really, since COVID, I think the conversation around money, and especially the hard stuff around money, has really exploded because we all had so much time to sit and think and ruminate on where we were at a point where we were worried about our jobs, we were worried about our health, and then eventually the government started throwing money at us and rates were ultra low. You know, we got to a point where we felt comfortable saying to a friend, I don't know about this investing thing. I don't feel great where I am. I have the time to fix it, so let's talk about it.
I want to just run some stats by you here. This is a survey that was conducted by Qualtrics on behalf of Intuit Credit Karma, and they're saying that this is a generational problem that disproportionately affects the millennial and the Gen Z populations. 43% of Gen Z, 41% of millennials saying they experience money dysmorphia compared to only 25%.
Should have entered.
14% of respondents age 59 or above, so maybe the boomers in that category. But is that surprising? I would go back to my own childhood and my early adult life where I lived paycheck to paycheck, mostly in my 20s. And I remember trading during that time, and I was always taking money off the table too quickly. Any profits, I I would quickly
On
take them off the table.
yes, this is what we're looking for, right?
What was happening, and now with hindsight, I realize a lot of these issues are related. But I just
Whether it breaks this or it continues to create this sort of downward trend.
naturally have more money, and they kind of become a little bit more accustomed to having this money. And
So does it break from this?
I think the overarching reason to what
Looking
you
for
saw
a
in the
break.
survey is because as you get older, you accumulate more money, you feel more comfortable where you are. But I definitely think that there's a generational aspect.
So this time is specifically more difficult, especially for younger people.
I think younger people have a lot of tragedy or trauma to grapple with when it comes to
And this is
money
where we
and when it
continue
comes
to
a lot of
hold.
world changes. Like, I'm a millennial, so I can speak most confidently from a millennial point of view. But I mean, millennials had to go through the tech bubble bursting, the great financial crisis, and COVID. 3 world-altering crises in the span of, I mean, count it up, 20 years or so, in their formative years too. I mean, I said this in my piece, but I was in high school during the great financial crisis, so I was too young to open a brokerage account, but I definitely felt it. Both my parents, my mom lost her job and my dad lost a lot of income as a residential electrician, and that affected my risk tolerance. I saw the bad side of risk. So I think a lot of the millennial and Gen Z population is at a point where they've seen a lot already in their lives, and you contrast that with an incredibly unaffordable environment where, you know,
We're just
everybody's
highlighting our
touting
areas of
homeownership, but
interest.
it's become less and less reachable, and you have a really tough recipe where you have to grapple with a lot of these thoughts.
All right, we got to get
That's
to
what
our
we're
one-way
looking for,
showdown
to
here,
push
where
back up
investing
here.
style meets market reality, and we're going to keep it on market psychology. This is a great discussion here. Today, it is a battle between two.
Again, since we talked about it in the beginning, the big move, ultimately, we're looking ideally for a move into 63.40.
Living for today's gains while confidently ignoring tomorrow's risks. And on the other catwalk is the reality checker, hard hat.
We do have about 30 seconds left on these 15-minute candles that we are eyeing
Fundamentals as well as market realities.
here on Webull.
Callie, I have an idea of which contestant you might gravitate towards, but answer through this lens. Who's wearing it better in this stock market rally that we are in right now? The stylish vibe trader or the steady reality checker?
I think this is a personal style question, really. Do you prefer leather or do you prefer denim? Obviously, the vibes trader is winning at the moment. I'm more of a fundamental gal, so I would say that I'm wearing that outfit, and I probably relate to that a little more. But the gap between the two, I think, is just so wide that you're going to have a lot of different answers here. You know, I think this is where timeframes come into play. You know, if you're saving up for retirement, if you're thinking years and years down the road, then you're probably a little more fundamental like us. Ultimately, I say like us, Jared's like, but you know, you're thinking more about earnings in the economy and how changes in the American economy and the global economy affect the future over years and years and years. The vibes trader, you know, you're thinking more technician. Where is the price now? What are the price levels that matter?
You're lucky if the vibe trader is a technician.
I thought a vibe trader might be someone that has a longer time horizon, right?
Really?
Because I feel like they could weather a lot more volatility, because if you know years and years down the line, that's when you want to take your money out, that's when you want to retire. At least you have that mentality that
4 more minutes left on these 15-minute candles.
and maybe that is a little like interesting.
Yeah,
when we
different
talk
takes
about
on the vibe
psychology.
trader.
Beauty
But
is
yeah,
in the eye of the beholder.
because
right?
I would think if you're closer to your retirement, you are a little bit more careful with what the current state of the market is, and you maybe want to take some money off the table quicker than usual.
Well, you bring up a great point, and your time frame isn't something that it's not an ideal for everybody. You're right. There are a lot of investors closer to retirement, and they have to be a lot more conservative here because, you know, they're going to be living off their portfolio in 5 to 10 years. The thing I would say to that is you don't drop dead right after you retire. At least I hope you don't. You're going to be living for a few more decades if you're lucky. So there is an element of risk that you still have to take, but there's also a good middle ground that you can strike there between income, safety, and beating inflation over the long run with your investments.
All right, we're going to have to leave it there. Another episode of Stocks in Translation is nearly in the books. Be sure to check out other episodes of our video podcast on the Yahoo Finance site and mobile app. We are also on all your favorite podcast platforms. So be sure to leave and comment, and subscribe wherever you get your podcast. And we will see you next time on Stocks in Translation.
And getting smacked back down. We got 1.5 minutes left on these 15-minute candles. Tech is trying to hold up. This pullback on ES, it's largely because of small caps IWM. If you take a look up here.
Order filled.
In a position here, up 0.5 point. Just looking for another little push and then we're calling it. Let's see if we get the whole point here.
For the next 30 minutes, we'll give you the latest money news, cut through the
Nope.
jargon, and tap into expert advice, all designed to help you take
Can't be
control
greedy.
and build a stronger, healthier financial future. On today's show, we'll break down how prices you pay for goods may be higher due to tariffs. Plus, you no longer have to remove your shoes at the airport, so is having TSA PreCheck
Let's
still
get the
worth it?
point.
We'll dig in. And what high interest rates mean for your savings accounts and mortgage rates.
Let's see. Hughes wants to push. There we go. We got the whole point there. $62. Let's see where we come out. Could take the point here. $50.
We saw price gains in categories like appliances, toys, clothing, and
Let's take
order filled.
Up $300 for the day.
Appliance prices jumped 1.9% in June. That was the biggest monthly spike since 2020 when Americans were locked down at home and investing in their living spaces. Plus, Trump's 25% to now 50% tariff on steel and aluminum affects products like washers, dryers, and refrigerators, pushing those costs higher. Meanwhile, toy prices rose 1.8%, and with about 80% of toys sold in the U.S. made in China, this category is heavily exposed to any tariffs on Beijing. And sporting goods prices climbed 1.4%. The World Trade Organization says nearly 2/3 of sporting goods imported to the U.S. come from China. The U.S. is also a major importer.
Came out green. What I was saying is the candle just straight wicked, right? We're struggling on that breakout. But we ended up with an additional about $37 to $40 gain. We're up $300 on the day now on each account.
Travelers, feel free to tie up those shoelaces tight because people traveling through domestic airports no longer need to remove their shoes while passing through security. For many years, that was a benefit only available to people in trusted traveler programs like TSA PreCheck. So now that everyone can keep their shoes on, is TSA PreCheck still worth it? Here to weigh in is Ben Walker, our senior writer on the credit cards beat. So Ben, if keeping your shoes on is no longer exclusive, what are the other perks of TSA PreCheck that still make this worth the money?
Yeah, I mean, I still think TSA PreCheck is going to be worth it for a lot of people. You know, it's fairly cheap.
or free with certain credit cards, and it still offers, like you said, multiple perks that your standard passenger is not going to get. That includes, you don't have to remove belts or light jackets. You can also keep electronics and eligible liquids in your bags. And in some cases, you might also be able to avoid the full body scanners, which take longer, and instead use the walk-through metal detectors. For me personally, I don't want to give up the convenience of not having to remove large electronic devices from my carry-on luggage anytime soon, especially since I normally travel.
So what we're mainly looking for here is a break of this trend. That's what I'm hunting for, a bigger move.
Honestly, it just seems like a bit of a
I take profits when I get them, so no need to be greedy.
Situation. How much time are you really saving with PreCheck these days? Is it still a noticeably faster experience, especially now that programs like Clear are more widely available?
Yeah, I mean, great question. I would say in many cases, TSA PreCheck lines will still move quicker than your standard TSA lines. It obviously depends on the airport and the specific checkpoint you're at, but like the TSA website says, about 99% of TSA PreCheck passengers wait less than 10 minutes. So there could be multiple reasons for this. This could be because TSA PreCheck travelers are more experienced, meaning they already know what they're doing. And they also have to remove fewer items from their bags, and they possibly don't have to do those full body scans. So all of these reasons could point to TSA PreCheck lines moving faster than your standard lines. But one caveat to all of this is that wait times and even TSA guidelines can be highly dependent on the specific airport that you're traveling through. So in some cases, you might get through the standard line quicker than your friend in the TSA PreCheck line. It just depends on what's going on that day. But overall, I have more confidence using TSA PreCheck, especially paired with the Clear Plus membership. I can often
Let's eye the rest of the market.
PreCheck line and be through security very quickly.
And Ben, can you break down the cost structure of TSA PreCheck for us? What exactly are travelers paying for, and how long does it last?
Very tempted to go long here again.
For TSA PreCheck runs between $77 to $85.
But IWM is struggling.
It comes to about
IWM is the one closest to a new low of day.
There's a range in these prices because it depends on which provider you're applying through, and there are 3 different providers. If you want to renew, it'll be between $60 to $70 or so to renew for another 5 years of membership. And some of the providers provide a discount if you renew online to make it a little easier. Just remember, there are ways to cut the cost of TSA PreCheck even more, even though it's already pretty low cost. One of the easiest ways is to have a credit card that covers the application fee. And there are dozens of these types of cards available, like the Chase Sapphire Reserve, Capital One Venture Rewards. So there are plenty of options to choose from. One last tip I would say is that if you plan to travel internationally, consider applying for the Global Entry membership. This membership can help expedite your entry back into the United States, and it also includes a TSA PreCheck membership. So you get multiple benefits for the price of one.
All right, Ben, thanks for that. Appreciate it.
Thank you.
Well, we're in the doldrums of summer, but that doesn't mean it's too late to plan a last-minute trip to escape the heat. Joining us now with some tips on saving for and paying for your next big vacation is Yahoo Finance personal finance editor Casey Bond. So, Casey, what are some tips would-be vacationers should keep in mind when they're saving up for that dream trip?
Well, the first thing to keep in mind is having that vacation budget in place. Do some research about how much your trip is going to cost you roughly, and then divide that number by the number of months you have to save. So that'll give you an idea of how much to put away every week or every month to reach your goal. Also, a good idea is keeping those funds in a high yield savings account. This allows you to earn a competitive interest rate. So while your money is sitting in the bank, you're growing that balance as quickly as possible. And then finally, consider automating your contributions. This takes some of that mental pain away from physically transferring money out of your checking account every month. And it just ensures that you're staying on track and consistent.
Okay, so that's good advice. And what are some other smart strategies to keep in mind when you're paying for that trip so that you're not overstretching your spending limits?
Well, several studies have found that about a quarter of people with rewards credit cards have points that are just sitting in their account going unused. So I would definitely recommend that if you do have a rewards card, you take a look and you see what rewards balance you have, and then see what the rules are surrounding redeeming those rewards and how you can boost the value as much as possible. If you don't already have a card or you're considering getting a new one anyway, look for a rewards card that has a sign-up bonus. So by spending a certain amount of money within a certain period of time, you can earn a sign-up bonus of rewards points that are often worth several $100s, even as much as $1,000 that can go towards that trip. And then finally, an alternative financing option to consider is buy now, pay later. A lot of these services allow you to break up the cost of, say, a flight into smaller installments. So as long as you make those payments on time, you will incur very little to zero interest on that purchase.
And how far in advance should you realistically start saving for a vacation? And is there a particular rule of thumb on how much to set aside each month?
Well, how much you're going to set aside is really dependent on your overall budget, whether you have, other expenses that you can cut back on to allocate more funds toward that vacation. But really, the sooner you can start saving, the better, especially if you're earning a good interest rate on, in a high yield savings account. That's really just going to boost your balance the more time you let it sit there.
All right, Casey, thanks so much. Appreciate your insights.
Thank you.
Well, recent changes to tax policy have eliminated EV credits that were designed to encourage electric vehicle purchases. Yahoo Finance's Prasi Romanian has the details.
I mean, look, you need to act now if you want an EV, right? So Trump's budget bill sunsets that federal EV tax credit of $7,500 for new vehicles.
We are heading into the last 5 minutes of these 15-minute candles we're watching.
While smaller state incentives are still there, the federal credit was sort of the main impetus driving the sale of EVs in America. It first began in the Obama administration in 2008, and Biden expanded that during his term, right, to include both the new and used EVs. And in addition to that, there's a point of sale situation where the actual credit actually gets deducted right when you buy, as opposed to waiting when you file your taxes. So it's just the best time to buy is right now. And if you want to buy, and then there's also the lease loophole, right? So lease loophole allows for you to lease any EV. It doesn't have to be American. Doesn't have to be under a certain price or a contingent upon your income level. You can lease any EV and get that $7,500 deducted from your lease payment. So look, it's the time to, if you want an EV, now's the time to get one.
All right, yeah, and like you're saying, you can save some money there. What are some of the tax credit eligible EV models on sale right now?
I mean, so for purchase, you're going to be looking at a lot of the American brands or cars that are made in America, which is beyond the Cadillac, Lyriq and cars like that, but also the Honda Prologue, which is made by GM in the U.S. That car also is available for the tax credit. It's a Ford F-150 Lightnings, and of course, how can we forget Tesla, Model Y, Model 3, Cybertruck. All those vehicles also made in America, and they are eligible for that loophole. And I'm sorry, for that tax credit. If you go to the Tesla website right now, they have a big banner that says, "Act now to get your Tesla before this goes away." So manufacturers are sort of talking about it. There's a bunch of inventory still available. I imagine by the end of September, it's going to be kind of dwindling. So now is your best time to get the best options.
In July. But what does that mean for you and your money? I'll break it down. Plus, we'll explain the correlation between interest rates and mortgage rates, and another installment of Ask Yahoo Finance Anything. That's next.
My account totally lagged there. What in the world? Did not fill me? I was trying to catch this. A little bounce off of it. It just froze. The TD froze. What in the world? It's okay, it's okay. Patience. CIW I'm pushing. That's why I wanted in. Two minutes left on these 15-minute candles.
Order filled.
Wow, finally. Let's see if we get anything out of this. Jeez, of course it does it now. Just keep an close eye there on IWM and Qs. Qs right under VWAP. Positions just hitting at break even or sitting there. See if we can go green. Just even a slight pop in and out. Nope. $30 left on these 15-minute candles we're eyeing. Down a point. New 15-minute candles about to form here in 2 seconds. There we go. New candles.
Federal Reserve is widely expected to hold interest rates steady at its July meeting, keeping rates in a range between 4.25 and 4.5%. But what does that mean for your money? Well, it depends on your financial situation and your financial goals. The Fed's benchmark rate, known as the federal funds rate,
Let's see if we get a slight break here.
is something called the prime rate. The prime rate is what commercial banks charge their most creditworthy customers. Your personal interest rate for things like loans or credit cards is based on that, along with your credit score and history. When the Fed raises rates, the prime rate tends to rise. When the Fed cuts, it usually falls too. The Wall Street Journal publishes the most
Come on, IWM. We need that push between both.
10 largest U.S. banks to get it. So, what does this mean for savers? Well, when the Fed keeps rates high, banks often raise deposit rates to compete for customer cash, meaning you could earn more interest on your balance. Certificates of deposit, or CDs, may offer particularly attractive rates, though they're still below the peaks we saw in 2022. If your bank starts lowering rates, or if you're opening a new account, it may be worth shopping around. On the flip side, for borrowers, higher rates mean you'll pay more if you carry a balance on a credit card or take out a new loan. Mortgage rates are indirectly tied to Fed policy, and while the Fed is expected to hold steady until at least September, that still means homebuyers are looking at mortgage rates hovering around 7%.
Some retracement here. It's not wanting to hold or pop above VWAP on Qs.
In this chart here, which tracks the average 30-year mortgage rate alongside Fed actions. So what should homebuyers keep in mind about current rates, and what's the outlook for the rest of the year? Joining us now with more insight is Melissa Cohn, Regional Vice President at William Ravis. So Melissa, we often hear that the Fed doesn't directly set mortgage rates, but it does influence them. So can you walk us through that relationship and how Fed policy decisions trickle down to homebuyers?
So mortgage rates are really tied to the 10-year Treasury yield, which is impacted by the same data that the Fed looks at. So when there's weak economic data, bond yields go down, mortgage rates go down. At the same time, if the Fed sees that the economy is weakening, then they would be more likely to cut rates based upon that same data. So mortgage rates, bond yields, Fed funds rates all sort of travel in the same direction generally based on economic data and the rate of inflation.
Right, economic data, expectations, and given where we're at in the current environment, what do you think lenders are watching most closely? Is it inflation? Is it Fed signals? Is it the 10-year yields, or all of the above?
I mean, it's obviously all of the above because the bond market is going to react to what the Fed does, what the Fed says. You know, if the Fed at the end of this month says that they intend to remain hawkish on inflation and that they continue to worry about the inflationary impact of tariffs on the economy, you know, the bond market will probably react negatively, and that will cause mortgage rates to go up because the fear is that rates will stay higher for longer. if the Fed has the opposite statement and they take a more dovish look and say
2 minutes left into the first 5-minute candle we're watching. Down half a point on my position.
Cut, and then the bond market would rally and mortgage rates would come down.
So with the Fed widely
Trying to break even. Let's see if we get any sort of gain here.
September, what's your call, at least directionally, on where mortgage rates could be heading in the second half of the year?
I mean, we continue
Up a quarter.
to see that, you know, the employment sector is
Just struggling with that push.
not as strong as it has been. So a weakening employment sector, we've seen other weakening areas in the economy, and that the rate of inflation, while it's gone up a little bit on the retail level this past month, is still
Just
pretty
struggling
much
there.
where, you know, the rate of inflation has been. So my hope is that the Fed will cut in September and will indicate that further cuts are potentially will happen at the end of the year, and that mortgage rates will settle down. I think it's all going to be based on what
Just hovering there. Let's see. Can IWM push us a bit?
Expectation is that we will see lower rates by the end of the year.
And if the Fed does
Might just take if we go up half a point. Nah, I'm going to stop being greedy.
Could we see mortgage rates stick near that 7% level, or are there other factors that could maybe bring some relief for buyers, even if we have this higher for longer interest rate environment?
Well, you know, the bond market is very reactionary, and bond yields move up and down every day.
5-minute candle about to close here. New 5-minute candle. 10 minutes left on these 15-minute candles we're watching. And that would lead us into power hour.
Rates can drop even if the Fed doesn't cut rates.
And for people on the fence right now, do you recommend buying and refinancing later or waiting it out? What's the smartest move in this market that can be a little bit confusing?
Honestly, if I get my quarter point here, I'm just going to take it and reset. Not liking this.
So I would tell you to buy when you find that right home, and that if you can
God willing, let's see.
afford the home at today's interest rates, when hopefully
So IWM is trying to push, but tech wanting to slow
a
down.
win-win situation.
Melissa, thank you so much. And you can scan the QR code below to find full coverage of mortgage rates. Well, market volatility brought stocks to lows in April and back up to near record highs today amid uncertainty around President Trump's trade and tariff policies. The whiplash has left many in or near retirement with questions, and we want to give you answers. So joining me now is Yahoo Finance's Carrie Hannon. Ask Yahoo Finance anything. So Carrie, some of your readers wrote in about this. One asks, quote, I am worried about inflation coming back with all this tariff talk. Given how crazy the stock market has seemed to be this year and the cuts at the Social Security Administration, should I be considering delaying my retirement? I had planned it for next year. Carrie, what do you think?
Well, you know, this is such an individual decision. You know, I'm a big fan of working longer. The longer you can postpone retirement, the fewer years you need to support yourself from all your savings during retirement. With longevity, the idea of you retire at 65, you could have 3 decades to support yourself. So I'm a real big fan of pushing it back, but you really need to look at your own situation. One guideline that Fidelity often uses is if you're 67 and you think in retirement, you should have 10 times your pre-retirement income set aside. So that's just a way to look at it. But there's so many individual caveats here. But what I'd like to say is really, I encourage you, if you're healthy and you like what you're doing, by all means, if you can stretch it out a little bit more, because what it allows you to do is continue to put into retirement accounts to sort of stave off dipping into them. And potentially to push back taking Social Security to age 70 from your full retirement age, where you'll get the biggest check for the rest of your life. These are all things that are super positive. And if you're not 65 yet and you're with an employer with health insurance, boom, you've got some health coverage until then. So again, it really gives you some time. If you have a little leeway, also look about if you're worried about that volatility. Can you adjust your portfolio a little bit? Can you make some rebalancing so you have a cash set aside, enough cash to cover some living expenses through next year at least, should the markets get a little volatile next year as well.
All right, Carrie, this next one, definitely top of mind. Another reader asks, can AI help me figuring out if I have enough saved for retirement? So can we trust AI with this, Carrie?
AI is not really great with math, to be honest with you, but I do think it can be super helpful. And in fact, I played with it myself with Chat GPT. I looked at it to see what, I asked some questions. It is wonderful to answer basic questions about retirement, and it's a great educational tool. I found the answers to be very clear, very direct. Straightforward. They counseled me at the end to talk to a financial
1.5 minute left on the current 5-minute candle, which would leave us with about 6 minutes until power hour.
So that I had more growth in my retirement savings in case I were to have longevity and longer life. So I asked, for example, what at my age, how much should I have of my portfolio in stocks? I asked, what is a target date retirement fund? And I asked, when should I start taking Social Security? And I would say it was super helpful what they told me. But again, they definitely covered the bases and said, go talk to a financial advisor for your situation.
And Carrie, you also got a question on Medicare coverage. Given some of the recent cuts and changes under the Trump administration, this reader says,
Still down about a point on my position. We are about 40 seconds away from going into the last 5 minutes before power hour.
Another reader wondering if AI can help answer these difficult questions for us.
I know. AI is just so buzzy right now. It's top of mind. Yeah, AI, once again, like I said about the retirement planning idea, it can help you. It's a great way to compare what is Medicare, traditional Medicare, what is Medicare Advantage, what are the pros and cons of these things. It can give you some really good educational basics about Medicare. It's not going to tell you what the right plan is for you. This is a very personal decision.
We are now going into the last 5 minutes here before power hour. Let's see what they give us.
Out there to ask some questions about what it is that Medicare can do for you and what things you need to be thinking about. But you might
IW, I'm trying to push, but we're looking at that slip in cues or tech.
They might recommend somebody who specializes in Medicare coverage to walk you through some of the possibilities for you. And you can also go, there's a couple of different places that can offer some free advice. The first one is and I'm going to look down to make sure I say it right, the State Health Insurance Assistance Program. These are in all the states and they're free right now. Medicare Rights Center also offers some help for you as well as going straight to Medicare. They've got some great resources there as well. But again, it's a big decision. Take your time. Yes, use AI to sort of get the nuts and bolts of it, but you're going to need to talk to somebody one-on-one to decide what's best for you.
We have a bonus question for you, Carrie. One of your readers says, I turn 65 later this year and am still working. Do I need to apply for Medicare? What say you?
Oh, that's a really great question because as I just said, work longer. So the point is if you are employed at 65 and your employer provides health insurance, you should check with HR there. But yes, you should be perfectly fine staying on your employer plan. That said, you absolutely have to apply for Medicare. I think you have a 3-month window before you turn 65 and that you need to apply for. Don't apply for Medicare Part B, but you need to enroll in Part A. That's all you have to do. There's nothing beyond that, but you need to get started in the system that way. And then when you leave your employer, then you can step back in and do the other things. But again,
pretty significant retracement here on Qs.
You should be covered by your
now IWM following. Looks like they want new low of day.
Right, Carrie, great context and answers there for our readers. Thank you so much.
Thank you.
Well, that's it for Mind Your Money. Scan
We got 3 minutes left until power hour.
Newsletter, and stay tuned for Market Domination. That's coming up next.
They're just within that range. Down 2 points on my position still. Might be a time to take a stop loss. We'll see. Going into the last 2 minutes of these 15-minute candles we're watching. We are now going into the last minute of these 15-minute candles we're watching, and that is the last candle before we enter power hour. Let's see, 30 seconds remaining here. Where do we end up? Where do we go into power hour? "15 seconds. There we go, new 15-minute candle. This is the official start of power hour. Down a point here. Let's see if we can get that slight push and just exit, or if we're just going to reject here and make a low. Come on. Let's see, still down about a point and a half.
Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. There's just an hour to go until the closing bell, and stocks are coming off session lows here, following those fresh records on Thursday. The Dow slipping nearly 200 points, while the S&P 500 and the NASDAQ trimming gains to hover near those records. The slide coming as President Trump is reportedly pushing for a higher blanket tariff on imports from the EU. Financial Times reporting that Trump wants a minimum of a 15 to 20% tariff on EU goods as part of any deal. Just moments ago, President Trump saying he will be signing that landmark Genius Act to regulate cryptocurrency.
We are now break even. We're literally just looking for a pop here, or whatever I can take. If we take anything, might just get smacked back down.
Standing by with more. Jared.
Thank you, Josh. As you said, we are experiencing just a tiny bit of downside in the markets. Dow down 175 points, about 0.4%. Here's the NASDAQ. It's been leading all week. It's just barely down.
Slight push. That's all we need.
As well. And then we'll go to the S&P 500.
Nope, getting smacked back down. Let's take a look at the rest of these. Yeah, see, it's IWM's not wanting to push.
Intraday price action. We actually gapped up to a record high on the open there, but then we drifted in a negative territory. I'll tell you what, these tariff headlines don't have the kick they once did. So this is a very muted reaction given the weight of these potential.
So we're 2 minutes into power hour.
Let's take a look at the VIX, because this has been down this week, up just a little bit, but 16.62. That's pretty close
down a
to the
point
that we were seeing earlier in this year when we were at record highs back then.
Yeah, this candle's not looking good at all.
Off of that 4.5% mark that we saw earlier in the week, it's down about 3 basis
Don't
points
like
today.
it.
30-year critically still at 5%, but it was as high as maybe 7-8 basis points higher a few days ago. And we'll just check out that 5-day chart real quickly. That was that Fed commentary right in here. We're going to be talking about that for sure in a few minutes. Finally, here's the U.S. dollar index over 5 days, down slightly today, up just a little bit for the
first 3 minutes of power hour completed.
Sector action, and this is the NASDAQ. We'll go back to that in a second. Here's the sector action. Utilities leading the day. You don't see that by too often, and by such a high margin, 1.75%. After that, you have consumer discretionary, thanks to Tesla flying high today. Then you have real estate and financials. That rounds out the winners. We also have materials and financials outperforming. To the downside, energy has had a bit of a tough time this week with crude oil under pressure. It is down.
IWM trying to hold.
Services down 0.7%. And we'll take a quick look at the NASDAQ here.
But
you can see
tech,
kind of a mixed board for
tech's
the
the
mega
one
caps.
wanting to give up.
Nvidia coming off a record high, that's down 0.5%. But as I said, Tesla screaming higher, that is up 3%. And we'll take a look at the Dow here, and we can see kind of a mixed board as well. Some of the names that are leading to the downside: AXP, American Express, down 2%, Chevron down almost 3%, Coca-Cola, a Staples company, down about 0.2%, and IBM, that is up 1.35%. It's been hitting record highs recently, and I'm going to close on this. We don't usually see the utilities board light up, but this is a sea of green today, so I thought we'd show it anyway. I love most of these tickers, everything except CIG in the green. And on that note, I will send it back to you, Josh.
All right, Jared. Well, let's kick it out right now to Yahoo Finance's Jennifer Schonberger, who is with Chicago Fed President Austin Goolsbee. Jen.
Thank you, Josh. And Austin, thank you so much for joining me. It's great to see you and have you back on Yahoo Finance on this last Friday before your blackout period.
Yeah, thanks for having me back, Jen.
20 seconds left on the first 5-minute candle.
Sorry, what were you going to say? I want to kick off the conversation with the fact that the Fed
No,
has
I just said thank you for having me on. Yeah.
Great to have you. I want to kick off the conversation.
There we go. Let's go into the second 5 minutes.
To see what the impact of tariffs will be on inflation over the summer months before charting a course forward on interest rates. And we got the first reading of that this week with the June CPI. We saw that tick up 0.1 percentage point to 2.9%. That was up from 2.8% previously. Are you seeing any indication that tariffs are pushing up inflation now?
I think you saw it on goods. If you look at the core goods inflation, especially in some of the heavily imported stuff, you were getting a warning sign. I took some encouragement that the services and the housing parts of core inflation still remaining pretty tame. But to me, that all fits into the space of still wait and see what is to come. And it doesn't help that we're going to announce a new round of tariffs that are going to apply to domestic production, parts, components, copper, supplies. We're going to go back and revisit tariffs on Canada, tariffs on Europe. There is a sense in which we need some resolution that we can count on before we can fully understand what the impact of this is.
How does that new round of tariffs that have been announced, and we've seen the president send out letters stipulating what tariff rates could be. Of course, we could see some negotiations, but those tariff rates are anywhere from 20% to 50% on some of our largest trading partners. How does that change your outlook for inflation?
I mean, that's the dual problem is if we're making these announcements in a kind of a drip fashion, you can't just count on let's call it the economic theory of tariffs. Hey, it's a one-time increase in the price level. That's a transitory inflation shock that a central bank doesn't have to worry about. You can't really make that argument if it's not a one-time increase in the price level. That said, as I've been emphasizing, imported goods, which these tariff taxes apply to, are only 11% of GDP. So there is a sense in which if it will stay in the 11% lane, it doesn't have to have a big material impact on inflation overall. And what you're going to be nervous about are if the tariff announcements lead people to freak out and change their behavior, that jumps it out of its 11% lane. If you start applying them more and more to intermediate goods like parts and supplies and components, then it's raising domestic costs of production and it gets out of the 11% lane. Or if there's big retaliation, then again, it's getting out of its lane. We were getting some relief on all three of those fronts as we got some exceptions and where they were backing down and doing the negotiations. And I think we just have to hope that we back down on all three of those fronts again, because right now we're kind of ramping up on all three.
Yeah, Austin, you had said that the central bank could cut rates if we saw what you called, quote unquote, dirt come out of the air now that we're seeing more uncertainty and an increase perhaps on these tariff rates? Is this more dirt, or if you will, mud being slung? Does this prolong the timetable to wait and see what to do with interest rates? Has this changed your timetable at all on interest rates and cutting rates?
Going into the last 5 minutes of these 15-minute candles we're watching.
Dirt in the air. Now I'm going to have to start thinking about, is there such a thing as mud in the air? Or if the mud is in the air as it is getting on us? I think anything that makes it harder
1 minute, 6 minutes, 1 minute before that, 5.
to 2% inflation, anything like that is
Still down about 1.5 points.
Of when the rate cuts can happen. As you said, I have been of the view that before April 2nd, before Liberation Day, the dual mandate grounds of the Fed of just price stability and maximizing employment were looking pretty good. And it looked to me like we could afford to start cutting rates, and that rates, I was saying then 12 to 18 months from then could be a fair bit below where they were. Now, it's been 3-4 months, so now maybe we're...
All right, last 5-minute candle opening on these 15-minute candles that we're watching.
Get that uncertainty out of there, and we aren't off the path. If we are still on the way to 2% inflation, rates can come down, but we don't know if we're on the path to 2% inflation because we don't know on tariffs, on energy prices and geopolitics, and in a few different areas. We don't know until we know. We're going to have to wait and see what's happening in the data. If we get multiple more months of benign readings on inflation, I would be feeling more comfortable. If we start to see a ramp up on prices coupled with a ramp up and increasing the tariff rates, then we're going to just have to see how big an impact that has.
Given where we stand right now, though, Austin, do you still think that rate cuts are on the table in maybe the fall months of this year? Or are you looking more in sort of a hold pattern right now?
Well, Jen, you know, I always say, I don't like tying our hands ahead of the meetings. I want to hear what my colleagues around the table have to say. I want to see all the data that come in between now and then. But it's the biggest table literally I've ever seen in my life there. You've seen it. And so everything is always on the table. I have no problem. And as I say, if we can get the dirt out of the air and it shows we're still on path back to 2% inflation, then I think for sure it's realistic that rates could come down. It's just that if it gets cloudier and cloudier, so you can't tell whether you're on that 2% rate, that's to me is a recipe for waiting.
Fed Governor Waller has said he's concerned about the job market, saying that only 74,000 private sector jobs were created last month. He called that stall speed. And he wants to cut rates on July 30th. I'm curious for your thoughts on that and whether you share his views on the job market.
Well, you know the rules of the FOMC. I express only views myself. I don't weigh in on what other people think or what the committee thinks. That said, just looking at the total net job creation for the month, we saw last year when there are big changes to the amount of immigration, that can be an unreliable indicator. We need to think seriously about what's the break-even level of employment. I do still have concerns about the job market side. And if we were to start seeing, for example, significant layoffs, when the business cycle normally turns to recession, you start to see layoffs.
2 minutes left on these 15-minute candles.
At a not small clip. If we start seeing deterioration of the labor market, then that would be a major factor in my thinking.
The president's allies and advisors have been trying to paint Fed Chair Jay Powell's comments to Congress on renovations of the Federal Reserve's headquarters and buildings here in Washington as untruthful as they try to push him out because he hasn't been cutting interest rates. The president himself told reporters this is sort of a fireable offense, only to turn around and say that he has no intention of firing the Fed chair. We've heard from CEOs of major banks like JP Morgan and Goldman Sachs who've said the independence of the Federal Reserve is absolutely critical. Playing around with the Fed could often lead to adverse consequences. Is this campaign undermining the credibility of Fed Chair Jay Powell and the institution of the Federal Reserve and public support for the Federal Reserve? Do you worry that this is damaging and a potential threat to Fed independence?
Last minute of these 15-minute candles we're watching.
Look, Jay Powell's a friend of mine. He's a totally honorable guy, and I'm a big admirer of his as the Fed chair. I think he's a first ballot Hall of Famer. I'm not going to get into the politics. I'll just say I've been in the Fed for 2.5 years. Before I ever got to the Fed, I, as well as a virtual unanimity of economists, believe that central bank independence from political interference is absolutely critical to the operation of the Fed and of the economy. That if you just look at places where they do not have independence for the central bank, inflation is higher, growth is worse, unemployment and the job market do worse. And
new 5-minute candles open in here, or 15-minute candles.
Central bank, and as I say, it pains me to hear people actively discussing whether the central bank should be independent. I think it's.
Let's see where they take us.
Come of discussion like that.
Austin, we'll leave the conversation there.
Remember, we got
so much, as always,
3 of
your
these
insights.
candles
Appreciate it.
left.
Look forward to talking with you again soon.
Great to see you again.
My position's still down about 1.5 points.
See you in New York.
All right, thank you, Jen. And to continue the Fed conversation, let's get to Prairie operating EVP market strategy and the BigSkinny.com founder Lou Bassinet, and bringing back in Yahoo Finance's very own Jared Blickery. Lou, I will start with you. Some interesting back and forth there. I think we'll start with the tariff inflation impact. June CPI ticking up. All schools be telling us that was a warning sign, he said. Took some encouragement that services were maintained, but still wait and see, he says, Lou. Doesn't help we're announcing, he pointed out, a new round of tariffs. He mentioned copper, revisiting tariffs on Canada and Europe. He said we need resolution before fully understanding that tariff.
Down 0.5 point.
Yeah, there's a lot of moving parts, right, that they're still trying to figure out.
Hovering right around break even. Let's see if we can just exit for some profit here.
Inflation was the cutting rates, and now that's just gotten confused by, he called it dust picking up in the air. Look, I look at it this way. He pointed out a key data point. Imported goods are only 11% of GDP. So you're seeing there's this trickle-down effect that we're not exactly sure how the end consumer is going to face the tariff increases. And we saw it even in the Fed's beige book that not all companies are passing the costs on directly. I think of it like food. You know, farm to table means there's no intermediaries. When it comes to tariffs, there's tons of people in the supply chain that have an opportunity to absorb some of that cost, and we're seeing that happening. So I really think this is a difficult situation where the Fed has got to be in the position to try and divine the trajectory before they actually have clarity. Otherwise, they're going to be too late.
And Jared, on the subject of cuts, my friend, the timetable there, that came up. Austin Gouldsby telling us anything that makes it harder to figure out if we are headed back to 2% is extending the timetable of when cuts can happen. He went on to say if we can get uncertainty out of there, and we are still on the way back to 2%, rates can come down, but we don't know, he said. We need to watch the data. Your thoughts?
Yes, uncertainty is going to be around for a while. That's my thought there. I don't see it going away anytime soon, but we will
Let's
learn
watch
some
the
more
other
off
charts.
August 1st, and we keep kind of kicking this football. Well, we got to take a look at the next month's CPI. We got to take a look at the next month's jobs report in certain instances.
Just struggling there.
The market is still pricing in two Fed cuts, so 25 basis points apiece, or 0.5% total by the end of the year. So that's into that December meeting. There are a few markets I'm watching.
2 minutes on the current 5-minute candle left.
This is 30-year Treasury bond yields, and I'm going to show you a 1-year chart here. It's been knocking up against 5% several times over the last year, and every time it has, it's rolled over. But you can see it has not rolled over just yet. And the last time, and this happened earlier this week on some of those Fed headlines where Trump was going to fire Powell potentially.
Down a quarter of a
We saw it
point
tick up
again.
quite a bit here, and we saw risk markets tip over. We saw stocks sell off there. So I think that's a key consideration for what's going on here. Now, the Treasury can have some maneuvering room. Besant over there,
Break even.
Yield below 5% by doing
Really,
some,
any
technical
profit
things
we can
that
get, I'll
beyond the scope
take.
of this conversation to do that. But what's the
Let's see if we can
valve?
call it a day here.
Typically, it is commodities and the dollar. And the dollar here, this is a U.S.
Let's
dollar
see.
index chart. I'm going to put a 1 year. We have seen this trending down for the most part. It ticked up over the last few weeks, but this is definitely a downtrend since the beginning of the year. And if it keeps going down, that's just going to juice risk assets even more. And even if it goes up, that just means the commodities are going to be that release valve. This is a year to date of the commodities heat map that I have here. Platinum is up 60%, palladium up
Quarter of a point.
copper up
Do we
40%,
take?
silver 30%. So we've seen a tremendous amount of money flow.
Oh, almost half a point there.
Safety
Nah.
relief system, and I tie it all together
Let's
with
just take it.
the fact that the Fed is not even
Do we get the half
considering
point?
taking, if anything, they are going to be lower.
Let's take
Order
the half
filled.
point. There we go. It's going to push up here, but I just want to get out of that trade. It was not the best entry. I should have waited for that retest here, right? Let me slow this down a bit.
On the sale of the stock, right?
Should have entered here, right, on the retest, but I first entered here a little early. I did get some or actually I entered right around here and I got slight profit, probably even what I took now, but I wasn't patient, held through this retrace. All it did was come back to test the breakout downward trend, and it popped back up. The main goal end to end today is still up here. It's around 63.39 to about 63.42 is where we want to get into to kind of just end the day with some upward momentum, but we'll see how it goes.
We're used to working fast in Silicon Valley, but even this is fast for us in Silicon Valley. The speed at which you move President Trump's really incredible. And now today,
looks like so far, I don't know if I'll take any other trades, but so far wrapping up with a total of $320.
The crypto capital of the world. This Genius Act will unlock American dominance in the crypto industry by creating clear rules of the road. It will update archaic payment rails with a revolutionary new payment system. And it will extend U.S. dollar dominance, like you said, globally, by creating a digital dollar that people all over the world can use. And for every digital dollar in a crypto wallet, there'll be a traditional dollar in a U.S. bank account, which will create trillions of dollars of demand for U.S. Treasuries. So that is the power of this bill, is U.S. dollar dominance. This is a huge promise made and promise kept by President Trump. And there's just a few other people I'd like to thank. First, my family for being here. Thank you. And Bo Hines, who President Trump mentions, the director of our crypto council, he really did the heavy lifting here. So Bo, I just want to thank you again. And my chief of staff, Tracy Johnson, as well, who also does the heavy lifting. And Bill Hagerty and French Hill and all the congressmen and senators who have already been mentioned by President Trump, so I'll save the time, but it was really been an honor to work with all of you. This was really a team effort, but
David Hollerith is here for a look at the implications for the broader crypto industry. David, great to see you. Let's start with implications for stablecoins. As an industry, David, how do you think about the possible adoption curve here? Because some of the numbers that are thrown out, it's impressive, right? You got our own Treasury Secretary, Besant. He believes dollar-linked stablecoins, he says, could reach $2 trillion or more in market capitalization. But how do you see the adoption curve from here?
Yeah, well, Josh, there's even a higher estimate out there by Citigroup that says $3.7 trillion, which is interesting because the actual size of the total stablecoin market at this moment is about a quarter smaller than Fidelity's government money market fund. So that gives you a perspective about where we are with this. But the actual implications of what this legislation does is pretty broad in that it basically opens season for banks, large retailers, fintech firms, anybody to basically issue stable coins. And allowing that is going to be able to open up the ecosystem in a bigger way. Now, the main use case being looked at that banks are talking about is sort of cross-border payments. And
They get faster, they get cheaper, right?
yeah, exactly. And that makes a lot of sense for a big bank like Citigroup or JP Morgan Chase. It makes a little bit less sense for smaller banks and smaller companies, period. But when you begin to think about what else the Trump administration has in store and what the Congress might actually achieve, it begins to look more interesting. Like, for example, the SEC has been sort of gesturing towards considering ways to allow companies to tokenize stocks or bonds or securities. And so if you have an ecosystem where financial investors, retailers are just simply using the blockchain more often, this is how they would pay for things. So this is kind of the first step there. So
now we're getting that additional pop. Let's see if we do end up hitting. I think we do around 63.40.
I want to get your take. More broadly, it's a big moment for the crypto industry, right? And listen, a crypto lobby that has become much more powerful and influential. You own crypto. What do you own? Is it the tokens? Is it the ETF?
I just own in Coinbase. I'm a reluctant adopter of crypto, which I think is what's happening here. You're seeing.
Why do you say that? Why do you say
Because
reluctant?
I thought it was a fascination, right? At first, I would tell you that a limited supply of nothing, it can't be worth anything, right? But now you're trying to figure out it's being adopted. So I think this removed a key hurdle, and that's the decision of, is crypto a security or is it a commodity, right? The financial system was waiting for the all clear from the administration to say, hey, you can get into this and start this ecosystem and not worried about being regulated from behind. So I think this is a key moment that's going to digitize and bring the U.S. into the modern age in terms of currency. A lot easier to do it now and innovate from the front than it is to kind of go back and let someone else maybe take the lead. But
I was asking Lou some guys recently who are in this space about the recent rally in Bitcoin. Get your thoughts. I asked them what explains that, and they mentioned Crypto Week, but bottom line they said, Josh, do not overthink this. This is just strong corporate and institutional demand, limited supply, prices go up. It's that simple.
I agree with that, and I'd say the other thing is very interesting. If you price the price of Bitcoin next to the cost to mine the next incremental Bitcoin, it's almost perfectly correlated. So you would expect market price to be in line with how much it costs to get the next Bitcoin out. So those two factors, institutional demand, which seems unlimited. I can say from my own conversations, I'm on a board of a company that's considering a crypto treasury strategy. We're seeing strong institutional demand because it's a way to get liquidity in the form of equity as opposed to having to own the actual coins themselves.
There you go. David, by the way, great. Thank you so much for being on set with us. Appreciate it.
Absolutely.
We are just getting started here on Market Domination. Coming up. Could Trump's tariff uncertainty create a stagflation environment for markets? I speak to a wealth advisor on their side who says signs could be pointing in that direction. Stick around. Much more Market Domination still to come.
All we did was come up to VWAP, And they all rejected. Well, SPY and Q's did.
Stocks stalled out today as markets hover around record highs. Our next guest says there are some signs pointing to an upcoming stagflationary environment. Andrew Briggs, wealth manager at the Plaza Advisory Group at Stewart Partners, now with me. Andrew, it is good to see you. Actually, I want to start, Andrew, get your take on some more. We did get some more tariff headlines here, right? President Trump reportedly pushing for 15 to 20% minimum tariff on all EU goods. This is per the FT. You know, broadly, Andrew, the markets have been willing to kind of shrug off these headlines. I'm just looking at the broad gauge. We're basically flat. I'm curious to get your take on the market response there.
Sure. Thanks for having me. So, yes, I mean, they're obviously, as you mentioned, you know, the ingredients for stagflation seem to be kind of rearing their head as far as you know, inflation being elevated, or as we just saw in the CPI print, it's kind of starting to show its teeth through some of the good side. Obviously, what's this going to do to growth? Which the obvious answer would be at some point it should continue to slow it. Regarding your question on, you know, the continual announcements on the tariff front, you know, our belief has still been, and this goes back to even Liberation Day, that it really is first and foremost a negotiating tactic. You know, I think based off their move to put them off once they saw the Treasury spike, as well as some other measures as far as the impact on the large tech companies here, which control or dictate the performance of our market. I think the administration knows that, you know, the global world order, although they want to change it, you know, there's only, you know, what pace or what speed can they do so without causing complete disruption.
Let me ask you, Andrew, I want to go back to that first point you were making there. These signs you're saying, suggesting maybe a stagflationary environment. Just walk me through those signs, Andrew. What data points specifically are you looking for?
Yeah, so actually, I would probably say
we are now into the last 30 minutes.
Ingredients for stagflation. I actually don't think on the equation, on the inflation side of the equation, that's really going to happen. You know, the issue is, you know, I think from a tariff impacts endpoint on the on inflation, you know, at worst case, it could be a one-time spike. But the question is, you know, I know President Goolsbee was mentioning earlier, you know, the majority of inflation is still, so 60% of CPI, you know, is still services oriented. A significant portion of that is shelter. You know, if you get those starting to kind of alleviate and kind of come down a little bit, which certainly will offset the smaller proportion being good side, I think all you're really doing there is kind of reshuffling the deck as far as, you know, maybe not changing the level of the water, but, you know, just changing the kind of the constitution of that for whatnot. So as far as the data goes, like I said, you know, obviously there was some upward pressure on goods prices within the CPI front. Kind of got that for retail sales as well earlier this week. You know, how much of that was truly spending versus inflation. So, you know, I don't think I think it's too soon to sound the alarm on stagflation. It's obviously a possibility, but we firmly believe that, you know, that the long-term impact to inflation as of now doesn't look to be too extreme.
Lou, I want to get you in here today, get your take. We got a rush of economic data this week. I think broadly, Lou, it looked, you know, relatively solid, but what is your take?
Yeah, I'm with Andrew here that I don't think there's any red flag, immediate red flag that we got to freak out about, especially in regards to stagflation. I agree that the ingredients are there. I think they're in the store, but they're not in my shopping cart yet for stagflation. I look at one thing that's really counterbalancing all this data, and that is AI deflation, right? We're seeing some layoffs in the tech sector alone largely, and that I think is because of productivity gains. Any impact that we're going to see or any major impact from inflation and tariffs is going to be muted by AI deflation, in my opinion. So I'm not worried about stagflation. I think it's more about getting the timing right on the first cuts to keep the economy growing.
Andrew, we were talking economic data. We also got a rush of earnings this week. I'm just curious to get your thoughts. How would you so far generally characterize the earnings season?
Yeah, we're obviously, you know, early on. Some of the big names are yet to come in the next, you know, 14 days or so. obviously the bar was quite low, and they kept lowering second quarter earnings to, I think, finalized at 2.8% or so. So an extremely low bar, which obviously, as we've learned over history, is easier and easier to clear from that standpoint. But obviously, the banks, I think you guys were just discussing this, even on the crypto side. The big banks continue to be stronger, and where does that leave the small to mid-sized banks? So that's one interesting story I would take from the earnings thus far. But again, I think the interesting thing I will be watching as we get into next week and the following is when you get some of the Magnificent Seven to come out and report, is what they do say about the tariff front. Because frankly, when you're looking at, for instance, cost of goods sold, I believe the number is somewhere around 40% of their cost of goods sold is from international markets. So again, that's another reason, back to my earlier comment, where I would imagine the administration knows this. These are kind of the darlings, the top best companies in the world. I don't know how much they wanted to jeopardize that from that standpoint, which is why I think, again, there's potentially a limit on how much tariffs are going to impact that.
Andrew, thanks so much for your time today. Enjoy the weekend.
You guys too. Thank you.
Coming up, shares of American Express and 3M are sinking by topping earnings expectations. Going to check in on some of today's top trending tickers later in the hour. Stick with us. Much more market domination that's still to come. CBS announcing on Thursday that it will end its run on The Late Show with Stephen Colbert in May 2026. For more, we're bringing in now Alex Weprin, media and business writer at The Hollywood Reporter. Alex, it is great to see you. So let's dig into this, Alex. So Paramount decides they're going to cancel The Late Show with Stephen Colbert in late 2026. Immediately, of course, Alex, There's a lot of hot talk and a lot of hot takes about why this happened, as I'm sure you saw. Now, CBS is saying, Alex, not related to the show's performance. This was purely a financial decision, is what they told the Journal. What do you make of it?
I mean, look, the fact is the economics of late night TV have deteriorated over the last few years. I talked to a source who said that they don't think any of the current broadcast late night shows are actively profitable. The funny thing with CBS, The Late Show, it had higher ratings than Jimmy Kimmel on ABC and Jimmy Fallon on NBC. It had lower ad revenue than both of those shows. So I do think there is a financial argument to make here. Obviously, some people are speculating that it's connected to the pending Paramount Skydance deal. You can speculate about that, but there's really no denying that the economics of late night have changed a lot.
Alex, Puck News had some numbers around this, and they said, this impressed me, but you live in this world, Alex, so I just want to run these numbers by you. They said the show cost more than $100 million a year to produce, Alex. It was losing more than $40 million a year. I was impressed by those numbers. What do you think?
Well, I mean, think about it. Stephen Colbert, he's probably making low eight figures. They shoot in a midtown Manhattan theater that holds 400 seats. They have a staff of about 200 people. It's an expensive show. Like a lot of these traditional linear TV shows, they cost a lot of money. They cost more money than people think. And the truth is the economics of that just don't work anymore in a world where fewer and fewer people are watching, and you've got these upstart digital, programs that cost a fraction of that to make.
Alex, Rich Greenfield over at Lightshed, he was telling his clients this morning, he was like, listen, let's not lose sight of the bigger picture here. And what the bigger picture to him, Alex, was, he says that linear entertainment TV is dying, his words. And he went on to say, in fact, dying at a rapidly accelerating rate. He provides some data to buttress that point. Said consumers are now spending more time each day streaming TV than watching broadcast.
We're going into the last 20 minutes of market here.
Agree with that take, though. Linear entertainment TV dying, and it's only dying at a quickening speed here.
I think Rich is broadly correct. People do watch news and sports on linear TV, but when it comes to entertainment, and that includes late night, includes like scripted dramas, it includes comedies, people are streaming those, and they're streaming them on demand whenever they want. On Netflix, they might be on Paramount Plus. People are watching on their own terms when it comes to entertainment. Really, news and sports are kind of the only things people are watching live on linear TV now. And the changes we're seeing at The Late Show are reflective of that.
Why would, this was a question that Rich asked, Alex, I'll pose to you. He asked, why would a legacy media company invest in original programming for linear TV at this point, outside sports and maybe to a lesser degree news?
So look, you're seeing these networks. NBC, for example, is adding the NBA this coming season. They're adding more and more live sports to their primetime lineups. So they are going to fill more of this space with sports and news. There will inevitably be some gaps there, and it makes sense to maybe develop some cost-effective entertainment programming that can fill the gap and eventually go on streaming. But you're going to see less and less of that over time. You're just going to see more news, more sports on linear, and there might be a little bit of entertainment to balance it out that people can also get on streaming. But the way that these companies are programming their linear television networks is changing.
Do you think, Alex, The Late Show is just the first? We're going to see a lot more linear TV personnel and programming get the axe here?
Yeah, I mean, look, people I've talked to in the late night space are kind of on edge right now. They do think that other shows will follow. It's hard to think that NBC would cancel The Tonight Show, but you never know. Broadly, we do expect more late night shows to eventually get the axe. Maybe not next week, maybe not even this year, but over the next couple of years, there's really no doubt about it.
Alex, great to see you and to have you on the show. Thank you, sir.
Thank you.
Now time for some of our top trending tickers. We're checking in on shares of Chevron and American Express. First up, shares of Chevron, they are lower despite the news that they can move forward with that $53 billion acquisition of Hess. It's coming after officials dismissed Exxon's attempt to block that deal. So, Lou, this was a long time coming, we know. Yeah. Chevron wins this arbitration battle with Exxon, closes this mega $53 billion deal to buy Hess. Chevron CEO telling Bloomberg here this creates premier international and oil and gas company What do you think? You agree?
I agree. I mean, I work for Prairie Operating Company. We're not as big as Chevron by any means, but this is a key thing. It removed some of the regulatory hurdles to more consolidation. It gave them a lot of reserves, about 180 billion plus worth of reserves. And I think this is why it might be selling off some weakness. There's about $1 billion in synergies and cost savings. I think the market wants to see that realized. But I would say, I mean, the energy sector as a whole is down so much. It's so underweighted in the S&P 500 that there's really very low risk, high possible return here as we see oil prices kind of find where they're going to stick. I think you need around 70 for a lot of these operators to be very profitable. And but long term, I think this is a really good trend for the industry.
All right, moving on. Next ticker, American Express. Those shares are sinking despite topping earning expectations. The credit card company expenses of $12.9 billion were higher than expected in the second quarter.
2 minutes left on these 15-minute candles we're watching. That would lead us into the last 15 minutes of market.
Than expectations. It sounds like that was about, in part, investments in tech, risk management. Build business did top estimates. The CEO talking about here record card member spending in the quarter. Demand for premium products was strong. Credit performance, he says, best in class. We did see slip in there.
Yeah, I think people and investors are just worried about the consumer. When are they going to roll over, even if it's the high end of the consumer here? But I mean, you showed the numbers there. They blew out expectations on the bottom line. Strong revenue growth, almost double digits. Premium usage, no sign of weakness. I think everyone's just waiting for Godot here in terms of the consumer that's just going to struggle at some point. I just don't see it's going to happen, though.
All right. Well, coming up, here's another big name we're watching, Tesla, because those earnings are going to be in focus next week. We're joined by an analyst on their side to preview the results and tell you the best ways to be positioned in the auto sector. Stick around. Much more market domination. That's still to come.
Are you ready to master the markets and, dare I say, become a better investor in the process? Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights and strategies from some of the most influential minds on Wall Street and the boardroom. We're also teaming with some of the biggest rising stars in the financial community for key insights to help boost your portfolio, build your wealth, and make you a successful investor. Welcome to the Opening Bid Unfiltered podcast.
Welcome to Stocks in Translation.
Welcome to Financial Freestyle.
Welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk.
Welcome to The Big Idea.
Welcome to Yahoo Finance Sports Report.
Welcome to Where Your Money.
From Wall Street to Main Street to the C-suite, we're your daily lifeline. Because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts.
We're into the last 15 minutes of market.
Tesla in focus as second quarter earnings are on deck. President Trump's big, beautiful bill shifting the landscape with tax credits getting phased out. We're navigating how to play the EV sector with the Yahoo Finance playbook. Joining me now is the one and only Tom Narayan, here in the flesh, lead equity analyst of global autos at RBC Capital Markets. Tom, great to see you, especially on set. Let's dig right in. Tesla earnings on deck. Your clients are asking you.
Get ready for the last 10 minutes of market here. Let's see if we scalp anything.
A lot of negativity, right, in the past few months, I would say. But really, when you look at the numbers, the deliveries were actually all right. They actually beat buy-side expectations.
It was better than some feared, for sure.
Better than a lot of people feared. And really, people were thinking that there's this like backlash against deliveries, against Tesla. But if you really look in the numbers, that's not what's happened. Their performance in the U.S. was very similar to China. They have some stale models. They're going to have a more affordable model, supposedly.
And what is that? What is that going to mean for growth? I mean, you got the revamped Model Y, the new affordable model. What does that mean for growth of the EV business there?
I think it's a big deal because there's this fear that there's this anti-Tesla kind of mythology, so to
Well,
speak.
Sheryl Crow's out there. You saw she's selling the Tesla. Come on, it was making headlines. But that was a thing. I mean, Tom, we talked a lot about it. I think we talked about you, whether there was this brand damage.
Yeah, and the reality is, people, when you really dissect the numbers, it wasn't just Tesla. The whole EV space in the U.S. was down quite a bit in the second quarter. It's because of there's such a glut of used EVs in the market. I mean, a lot of my friends ask me, like, hey, what car should I buy? I'm like, you should buy a used EV right now. You can get some crazy discounts. That's what's pressuring the numbers. And this affordable car, I mean, let's see if it's actually coming in the third quarter. That's kind of the expectation. That can reignite demand. As you know, this is a narrative stock, right? People look at deliveries, and that's how the stock trades, even though we think it shouldn't. We think it's more about autonomy and robo-taxis and that sort of thing. But I actually do think if it does reaccelerate demand, you'll see the sentiment swing back in favor.
What did you make? I want to, while I have you, because you mentioned robo-taxis, the Uber-Lucid partnership, because you cover Lucid, get a sector perform. I want to get your thoughts on that partnership, and then I'm just curious, how do you think Tesla thought about that news?
Yeah, I mean, look, it's like 20,000 vehicles over 6 years. You know, Uber has relationships with lots of robotaxi companies, right? There's a relationship with Mobileye, which has the Volkswagen ID Buzz. So I think it's going to be one of many relationships. I think it's great for Lucid. I think the stock was up like 40% or something like that. That has more to do with Lucid and issues that that company has with the capital markets, and its people think of its survivability, et cetera. I don't know if this phases Tesla. Tesla's model is very different, right? It's let's switch on every Tesla on the road with unsupervised FSD and everything's a robotaxi. So
how that's the ambition. How do you quickly, Tom, does that Tesla robo-taxi service, how quickly does it expand, in your opinion?
We have to see. I don't think it'll happen overnight, right? But theoretically, if every Tesla has unsupervised FSD with just cameras, and you could switch it on and you don't need LiDARs and radars, that's a game changer. So it's more theoretical. I don't know if we're going to get there just yet. We have to see. Early indications on the Austin service, you know, a lot of people were expecting a lot of accidents and a lot of negative news. We haven't really seen it. They're talking about expanding with California and maybe Phoenix. So indications so far are promising, but only time will tell.
But bottom line, heading into this print, you do maintain the outperform, correct?
Yeah, I think so. I think the expectations on the sell side numbers are pretty low. The margin number is not that much better than the first quarter, and the deliveries were a lot higher. I know the energy storage number wasn't that great, but they're going to get regulatory credits. I think there's a good chance that they'll beat. But investors I'm speaking with are already positioning. That's why the stock, I think, was up today. So, you know, when it reports, we'll see. The other thing to keep in mind is what always drives the stock on earnings is the conference call. Commentary on the call, on robotaxi, on this affordable car. These really will probably drive the stock more than just the print.
What do you think Musk is going to say about China on the call and how that business is going?
Yeah, that's a big topic. I actually think that they're pretty optimistic there. You know, the China situation is more because EVs are selling like crazy. The big losers there are more about companies selling ICEs there, right? The German OEMs are really losing share. Tesla's actually doing all right. I think it'll be pretty constructive, pretty positive there. You know, the worry is really more about Volkswagen. Those types of cars are losing share, not really Tesla.
Let's talk about another big topic, which is tariffs.
Yeah.
And I'm curious how the auto names, the names you cover, Tom, how are they navigating that dynamic?
Yeah, I think there's been a lot of optimism in recent months about a deal finally being struck, and I think you eventually do get a deal. Now, some people had hoped that it was June, July timeframe. Now it's looking like maybe August timeframe. They're talking about the EU potentially doing a deal. Remember the EU has this tariff of like 10% on U.S. Exports over there. The U.S. auto industry doesn't really export anything over there. It's actually European car companies that do it. It's just because we have the chicken tax, right? The SUVs and pickups. So it's more of a retaliatory thing. So what people are thinking now is that the Europeans may drop their 10% lower, and the U.S. administration gets a nice W.
Entering last 5 minutes of market here in about 10 seconds.
Probably indicative of what we could see from Korea, Japan, other countries. I don't know about China. That's a whole other topic. But I do think eventually, and this is what a lot of people are thinking, you'll get the deals struck. It's not a question of if, it's more about when. I think it's more like August, September timeframe.
Do you think, I mean, we know what the president wants. He's very clear about that. He wants everything made here. Do you think we would ever see, Tom, an American auto name say, okay, we are actually going to we're going to build a big new final assembly plant here in the United States? Do you think we're going to hear that?
No, I don't think that's eventually what's going to happen. I think on the margin,
Order filled.
More, right? Actually, Mercedes has already talked.
Took my last trade here, another half a point snipe or so. It's just very volatile, right? 10-minute rig, closeout market. Could have gotten more, but I'm at 340. What a blessing. What a blessing.
Supplier base, maybe some of the Japanese OEMs may talk about maybe doing a lot more localizing here. USMCA could require U.S. contenting, which doesn't exist, which could require a little bit more U.S. content. So I think on the margin, it will increase U.S. productivity, U.S. production, but I don't think it's going to be wholesale, everyone bringing plants over here. It's just not practical. It would take not even years, potentially, decades to really do that. It takes 3 to 5 years to build a plant. So it would just take too long. You may have a new administration at that point. I think it's more on the margins.
New administration, new priorities, possibly. I want to squeeze one last one. Why is GM outperform and Ford is sector perform?
Yeah, I mean, it's also a function of just luck, kind of. GM decided to go into EVs a little later. They decided to invest in building their own battery capacity, which was a genius move. That's the one part of the IRA that's very much intact, so the government subsidizes building your own batteries. I think Ford started with EVs a little too early. Pickup trucks didn't really do as well with the Lightning. The Mach-E went right against the Model Y, and now you're having the GM EV train pick up. Now it's a good time. We have charging infrastructure, et cetera. Also, GM is 60-70% market share in large SUVs. It's like the bread and butter of the American auto system. They're not really, the China exposure, it isn't that big of a threat. And I think if there's a deal, which I think there will be a deal on tariffs, GM is the bigger beneficiary. They have a ton of Mexico exposure, ton of Korea exposure. So it also has more to do with how they benefit from tariff deal being made. Oh, and they're doing a ton of capital return. Ford really isn't doing as much of that.
Tom, as always, you make your case very clearly, convincingly. Thank you, sir.
Got it.
Appreciate it. While we are wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. That is the closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on
There we go. We're going to call it a day.